Come to order. Without objection, the chair is authorized to declare a recess or adjournment of the committee at any time. Without objection, the chair will recognize himself for 5 minutes for purposes of making an opening statement. Today, the committee meets to consider a number of different bills to help relieve the burden of regulatory red tape from our financial institutions, our entrepreneurs, our business startups. Many of these bills have bipartisan support, and I hope before the day is over that the rest will also enjoy bipartisan support. They should, because these bills are, on the one hand, modest, but they are all designed to provide, again, regulatory relief for job creators at a time when tens of millions of our fellow countrymen remain unemployed and underemployed. We received some bad news recently that more than 800,000 Americans, almost a million, left the workforce last month alone. Many simply could not find a job to make ends meet no matter how hard they tried. Millions others remain out of work. The latest economic figures show during the first quarter of this year the economy slowed to a stall, a barely discernible 0.1% annual growth rate. And just yesterday, the Brookings Institution released a study showing that the American economy is less entrepreneurial now than at any point in the last 3 decades. According to this report, during 2009, 2010, and 2011, businesses were closing down faster than they were opening up. The report goes on to say if this decline continues, America will suffer, quote, a continuation of slow growth for the indefinite future. So when we as a committee have the opportunity to help arrest this trend, to help put Americans back to work, to help create jobs, we have a responsibility to do so, and hopefully to do so on a bipartisan basis. This is why our committee has already guided 22 regulatory relief bills to House passage. And the vast majority of those bills, once again, have received strong, not just token, but strong bipartisan support. Now, it is most regrettable that the Senate, where all good ideas go to languish and fail, has indeed failed to take up a single one of those bipartisan bills. I would strongly encourage my Democratic colleagues who may spend more quality time with the Senate Majority Leader and the President than do I, to encourage them to take up these bills, to contact their friends in the Senate and the White House, and urge them to pay attention to what our committee has put forth on a bipartisan basis. This was indeed be very, very constructive. But again, despite the Senate's failure to act, we must act. Now, I have been told on the eve of this markup that many of my friends on the other side of the aisle are upset over IRS matters, Benghazi matters, and other matters. I assure my friends we too are upset over these matters, perhaps for different reasons. And if there are those who wish to use this markup to debate these issues, that is certainly their right and privilege. But I assure you the majority of us today are going to work to try to get America back to work and to attempt to pass these bills to empower our entrepreneurs and our job creators to put our fellow countrymen back to work, to end the anxieties we hear too often. Those like people in Adam in Mineola, Texas, in my district, who wrote me, quote, the complexity of all these different rules and regulations that the government imposes creates a climate of incomprehensible confusion and uncertainty for job creators. It should not be that way. We've got to move forward for the sake of people like Joseph from Maybank, Texas, who I represent in Congress, who wrote me, quote, I'm a disabled veteran and have been without work for over a year. All I want is to have a good paying job and let the rest happen as it comes. All members of Congress owe a debt of gratitude to Joseph of Maybank, and the least we can do is help empower more companies to hire him and get him that good paying job that he so richly deserves. In order to do this, we're going to have to work together to alleviate the burden of complex and costly regulations. I want to thank the members on both sides of the aisle who have worked together on a number of these bills. In addition, we had noticed in a markup the matter of to subpoena certain records and information from the Departments of Justice and Treasury. I am somebody who is patient, but my patience has limits. This has to do with a matter that has been the subject of bipartisan interest. Due to a conversation I had with the ranking member on the floor last evening, we haven't quite seen eye to eye on the process. In the interest of trying to work on this together, I do not anticipate that matter will come before this committee during this markup. Stay tuned as the ranking member and I try to see eye to eye on moving forward on these matters. Again, I encourage all of my colleagues at this time to work together to get these bills passed in a strong fashion and put America back to work. The chair now recognizes the ranking member for 5 minutes.
Thank you, Mr. Chairman. Today, as you have said, we will consider a number of pieces of legislation related to capital markets and financial institutions. The resolution that you just referred to related to the issuance of subpoenas has been taken off the calendar as you just described it. And I'm thankful that you are exercising some patience and wisdom in having done that for any number of reasons. Yes, we had a discussion about that. Yes, we talked about the seriousness of subpoenas. Yes, we had a discussion about what I felt was some of the work that needed to be done because subpoenas are extraordinary efforts and work that should be done prior to the issuance of subpoenas. So I appreciate that you have decided that we will not go forward today, but I also appreciate that you are very, very much interested in pursuing that, and hopefully, as we discuss this, we can come to some agreement about subpoenas in the very near future. The measures dealing with capital markets make changes to securities rules that would erode the transparency and investor protections that long have been a staple of our financial markets, particularly in the wake of the massive collapse of the financial services sector in 2008. These measures would reduce disclosure requirements and end certain restrictions on securities offerings while ignoring how it would impact the quality or availability of information investors need to make decisions. And when it comes to capital formation issues, these measures further the Republicans' troubling pattern of ignoring the fundamental fact that capital formation is a balance between companies and investors. Favoring one, in this case companies, has the potential to undermine the confidence of investors, which significantly increases the long-term costs for the very same companies and the entire U.S. economy. In addition, several bills preempt or prevent states from regulating securities, even where they play a lead role protecting investors from fraud. I have serious concerns with efforts to preempt state regulators, as well as with pursuing a piecemeal approach to changing the capital formation process. I believe we must not rush to take such dramatic action without a better understanding of how each of these bills interacts with the current offering process and each other. It is important that we preserve the information investors need to make decisions, protect the authority of the state regulators, and fight back against efforts to undermine the implementation of the Jumpstart Our Business Startups Act rulemakings, particularly before they even go into effect. In addition, today we will consider 5 measures related to financial institutions, the majority of which, as currently written, water down important rules that protect our nation's consumers from abusive lending practices. Mr. Chairman, I'm concerned that while these bills are well intended, they could open up cracks that will be used to significantly undermine consumer protection in the market mortgage market, while increasing the administrative burden on financial regulators, some of which are already cash-strapped. As we carefully consider ways to provide regulatory relief to small banks and credit unions, we must also remember it can be easy to overreach and undermine the consumers we're sent here to protect. And so, Mr. Chairman, moving forward, and thanking you again for taking the subpoenas issue off of the agenda. I look forward to the debate that we will have on these important issues, and I'm mindful that we're represented here, we are elected here to represent our constituents, and certainly I'm hopeful that we will all keep that in mind. I yield back the balance of my time.
Do you want to go ahead and appoint your ranking members? For what purpose does the ranking member seek recognition?
Mr. Chairman, to name Democratic members to the committee's subcommittees.
The ranking member is recognized.
Mr. Chairman, I ask unanimous consent to place into the record a document reflecting new subcommittee assignments for the committee's Democratic members.
Without objection, so ordered.
Mr. Chairman, pursuant to the committee's organizing resolution, I name Democratic members to subcommittees as reflected in that document. Mr. Murphy is now on capital markets. Mr. Perlmutter is returning to financial institutions, where he is joined by Ms. Sinema. Ms. Moore is returning to housing, where she is joined by our newest member, Mr. Horsford. Mr. Himes is returning to monetary policy and trade, where he is joined by Ms. Sinema and Mr. Heck. And Mr. Kildee and Mr. Horsford will serve on oversight. I thank the members and congratulate them on their new assignments.
So ordered. Now, pursuant to notice, I now call up H.R. 4200 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4200 to amend the Investment Advisors Act of 1940 to prevent duplicative.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Missouri, Mr. Lukemeyer, the sponsor of the legislation, for 5 minutes.
Mr. Chairman, I move to strike the last word.
Gentleman is recognized.
Thank you, Mr. Chairman. Thank you also for including H.R. 4200 in today's markup. I also want to thank Ranking Member Waters and the gentlelady from New York, Ms. Maloney, for her support of this legislation. The SBIC Advisors Relief Act is common sense policy that streamlines the registration and reporting requirements for advisors to small business investment companies, or SBICs. These are advisors to investment funds that make long-term investments in U.S. small businesses and have to the tune of more than $63 billion since 1958. Under current law, SBICs are heavily regulated and closely supervised by the U.S. Small Business Administration and have been for more than 55 years. The existing regulatory regime surrounding SBICs includes an in-depth examination of management, strong investment rules, numerous operational requirements, record-keeping, examination, and reporting mandates, and conflict of interest rules. These entities and the management of these entities are anything but unregulated. This robust regulatory framework has been well recognized by Congress. The intent of Congress is, in including some of these exemptions, Dodd-Frank, was to reduce the regulatory burden on smaller funds and SBICs. However, the law has resulted in some unintended consequences that must be addressed. The SBIC Advisors Relief Act does three things. Number one, it allows advisors that jointly advise SBICs and venture funds to be exempt from registration, combining two separate exemptions that exist, one for advisors of SBICs and a wholly separate one for advisors of venture funds. Number two, it excludes SBIC assets from the SEC's assets under management threshold calculation. And number three, it exempts these state regulation advisors from SBIC funds with less than $90 million in assets under management, leaving those entities to be regulated by the SBA as they are today. Mr. Chairman, I think we can all agree that these changes are common sense. During the April 9th legislative hearing in the Capital Markets Subcommittee, provisions included in H.R. 4200 garnered praise from members on both sides of the aisle and from witnesses who testified. Those witnesses agreed that H.R. 4200 streamlines the regulatory system and govern SBIC advisors. Mr. Chairman, I want to thank my colleagues who know that 4200 is not only bipartisan, but it also includes suggested changes by the SEC. Most importantly, this legislation includes sensible provisions that prevent redundant regulatory mandates and allow for greater investment in America's small businesses. I again want to thank Congresswoman Maloney for her help on this bill and ask that my colleagues support the measure. Also would like to take a moment to comment on your opening statement, Mr. Chairman, where you indicated that we're hearing a lot of small business bills today, and not many major pieces of legislation. Just want to point out that it's not any one piece of regulation or law or rule that's burdening our economy and causing our financial service industry to struggle providing services to their customers and our constituents. But it's an accumulation of all these rules and regulations that are burdening our society. And we can take one regulation at a time, one bill at a time. Through all the things we're going to do here today, it will be one large step toward taking that regulatory burden off. I thank you, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purpose? The gentlelady from New York seek recognition. Gentlelady's recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for moving this bill forward. And I move to strike the last word. I'm pleased to co-sponsor this bill with my colleague and friend, Mr. Lukemeyer, who has been a real leader on capital formation issues. H.R. 4200, the SBIC Advisors Relief Act, fixes an unintended consequence of Dodd-Frank. Under Dodd-Frank, an investment advisor that only advises a venture capital fund is exempt from SEC regulation. Also, an investment advisor that only advises small business investment companies, or SBICs, is also exempt. But an investment advisor that advises both a venture capital fund and an SBIC is, for some reason, not exempt. This absolutely makes no sense, and it provides no additional protections for investors. Also, it discourages investment advisors who may have experience advising successful venture capital funds that have invested in larger, more mature enterprises from bringing their expertise to SBICs who want to invest in similar startups. This ultimately restricts small businesses' access to much-needed investment capital. Our bill fixes this problem by clarifying that investment advisors that advise both venture capital funds and SBICs are also exempt from SEC registration. This fix does not pose any investor protection concerns because SBICs are already subject to strict oversight by the Small Business Administration, which supports SBICs by providing a guarantee on funds used by SBICs to invest in small businesses. The SBIC program has a long history of success and has provided early-stage financing for companies that have since grown to become worldwide icons, such as Apple, Intel, and Staples. I believe this is a good bill, and I urge my colleagues to support it, and I yield back.
Gentlelady yields back. Who seeks recognition? Gentleman from South Carolina. For what purpose? Gentleman from South Carolina seek recognition.
Would you strike the last word?
Gentleman is recognized for 5 minutes.
Thank you. And I thank Mr. Lukemeyer and I thank Ms. Maloney for bringing this bill forward. I think it's noteworthy, Mr. Chairman, of why we have to be here and why we have to do this. Think about what's happening here. We have said that if you do A, you are exempt, and if you do B, you are exempt. And somehow, somebody over the SEC said, well, you know what that means? That if you do A and B, then you must not be exempt. This is crazy. This is one of those things that you've got to wonder who is looking at these rules at the SEC and thinking, well, it must be Congress's intention that A and B, if you sell to both A and B together, then you are exempt. It's a shame that we have to be here, but I do thank both members from both sides of the aisle for taking the time to do it, because if it doesn't get done now, we cannot rely on the SEC to make some common sense adjustments in how they regulate these industries. So I thank Mr. Lukemeyer, I thank Ms. Maloney, and I hope we have the full support of the committee for this bill. Thank you. I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? Is the gentleman from Massachusetts seeking recognition? No, he is not seeking recognition. Gentleman from Connecticut, for what purpose does the gentleman from Connecticut seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, and I appreciate the effort in which these bills have been brought forward, or the style in which these bills have been brought forward. I don't agree with every one of them, but it's clear that there was good bipartisan work done to bring them forward. I do want to take one moment, though, just to perhaps correct the record. We all too often, in the opening of these hearings, hear, or at least hear the suggestion that regulation is primarily responsible for a reduction in entrepreneurship or a reduction in economic activity. And I would just point out that I've been sitting in this room for 5 years, heard 5 years' worth of Humphrey Hawkins' testimony, including the Federal Reserve's best guess as to why the economy continues to struggle. And not once has the Federal Reserve, the Congressional Budget Office, and the other group of respected economists suggested that too much regulation is meaningfully responsible for the economic difficulties that we have suffered. Aggregate demand, weakness in housing, uncertainty in Europe, these things come up time and time again, and I feel compelled to make that point because I think what we're doing here today in the spirit of bipartisanship is looking to find that balance. And I don't mean only to point to the argument of the other side. I bear more than my fair share of scars from those on this side who believe that any attempt to alter regulation is the devil's own work. I make this point because this is about finding balance where the markets are regulated in such a way that investors feel confident putting their money into those markets. In that spirit, I'm very pleased to join Mr. Luke Meyer and Ms. Maloney in advocating for this very commonsensical and bipartisan bill. SBICs have bridged the gap between entrepreneurs' need for capital and traditional financing for a very long time, since 1958. It's clear from those who understand SBICs, including, by the way, many state regulators, that these companies are not systemically risky, are important to the growth of our economy. SBICs, including a number of them located in my district, have invested more than $280 million in Connecticut over the last 6 years. So I'm very pleased that this bill is coming forward, that it does appear to have strong bipartisan support, and would urge my colleagues to support it. And with that, I yield back the balance of my time.
Gentleman yields back. For what purposes the gentleman is recognized for 5 minutes.
Just two quick comments. A, I support the legislation that before us, and B, to the gentleman from Connecticut, I agree that if we listen purely to the panels who come us, who are either regulators or academics, we will only get one view. But if we go back to our home districts and listen to our constituents, they may tell you and us a different story. Part of the reason why there is not the demand in housing right now, you will hear from a lot of constituents, is because they cannot get a loan. And part of the reason there is if you talk to your local constituents who are bankers, they will say it is because of excessive regulation and the uncertainty in the regulation. Likewise in the capital markets. If you listen to the academics and the regulators as you do, you'll get one story. If you go back home to Main Street and to Wall Street, you will get a truer version of the story, and that is that it is uncertainty in the marketplace, that investors are not willing to go into a marketplace, that some of the firms in Wall Street are not willing to expand their operations because there is uncertainty as to the implementation of Dodd-Frank. So sometimes you have to go back home and listen to your constituents and listen and read a little bit deeper between the lines to understand exactly why demand is down right now, why housing is down right now, and why the economy is not taking off as it has in just about every other recovery, save for this one, thanks to legislation, excessive legislation such as Dodd-Frank. I yield back.
Gentleman yields back. For what purposes does the gentleman from Massachusetts seek recognition? Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I didn't expect to speak on this. I didn't expect 47 people to speak on this. This is the most bipartisan piece of legislation we're going to deal with today, the least controversial legislation we're going to listen to today, yet I just got a lecture on how I should deal with my own constituents. And I find that pretty insulting. I would suggest that the gentleman come to my district and listen to my constituents.
Will the gentleman yield?
I'm not hearing that. No, I just got a lecture. I don't need another one.
I don't think I was addressing the gentleman.
Well, you generally addressed all of us, is what I took it.
I did not address all of you.
Time belongs to the gentleman from Massachusetts.
Just to answer a question, were you only addressing one member of this side, or were you telling us all to go home?
I was responding to the gentleman from Connecticut.
Oh, well, in that case, that's fine. So you didn't mean me. I appreciate that. And
Absolutely not.
then I appreciate that. I guess if I shouldn't be so offended for my colleague's attack.
Does the gentleman yield back? Is there any other member who wishes to lecture or be lectured to? Or for what purpose does the ranking member seek recognition?
Thank you very much, Mr. Chairman. I
Move to
think,
strike the last word, I
I
assume.
move to strike the last.
Gentlelady's recognized for 5 minutes.
Both representatives from both sides of the aisle have talked about why this bill makes a lot of sense, and it does. I'd just like to bring one thing to the attention of our members. I've agreed to support this bill because I do think that it makes good sense. I also would like to bring to your attention that included in the bill is one little aspect that I have some concerns about. The bill also includes provisions that will prevent regulatory duplication at the state government level for investment advisors already under SEC oversight. It's a preemption of state regulations, and I'm concerned about that. I support the bill, but I would ask my colleagues to pay attention to preemption in the future because we do not want this to be consistent in what we do as we try to deal with regulations that perhaps are duplicative. I yield back the balance.
Would the gentlelady yield for just something?
Yes.
And this actually is not to the gentlelady, it's to the gentleman from Massachusetts. If it stops snowing up in Massachusetts finally, I will very be happy to accept his invitation to visit.
Reclaiming my time.
The gentlelady's reclaiming her time.
I yield back the balance.
Apparently she didn't like the weather report from Massachusetts. Seeks recognition. For what purpose does the other gentleman from Massachusetts seek recognition?
I thank the gentleman, and I
move to strike the last word, I assume. Yeah. Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. There is in this bill one flaw that the ranking member has pointed out, and that is that it removes the state regulatory scheme from the playing field here. And that is a pattern on a lot of legislation that we've seen come through this committee. Now, I do understand that with SBICs there is the ability for the SBA to provide some rigorous oversight, but I also know that in many cases, now not every state is the same, but in many cases that state regulatory filing requirement is a safety net for some investors, depending on the protocols in that individual state. With this legislation, while we are doing some good things, and the core of this bill is on target, it does, I think, address an unintended consequences, and I agree with that part of it. But I think the other section of this bill that removes state regulatory oversight is unwarranted and unwanted. I think there's an opportunity here to have a second set of eyes on these cases where the SBA regulatory oversight may be stretched and may not, in fact, be in play. So that's the one flaw I find in this bill, but I do congratulate the sponsors and the co-sponsors of this bill for trying to get to the unintended consequences, but I think we could have done better by allowing the state regulator to remain in the field, protecting investors, and that protection varies state by state depending on the rigor and the approach of the state regulator themselves. So with that, so for that reason, I will vote against this bill, but it's not because of the heart of this bill. It's just the practice here of taking the state regulator off the field. Thank you.
Gentleman yields back, seeks recognition. Chair recognizes himself for what will not prove to be 5 minutes. Just to say, number one, I'm in great appreciation to the gentleman from Missouri for his leadership, the gentlelady from New York on the other side of the aisle for working together. on a bipartisan basis. I wish I could have been as succinct as the gentleman from South Carolina to essentially reduce this bill down to its lowest common denominator. If you can legally do A and you can legally do B, why can you not legally do A plus B? So I'm not sure who concluded otherwise. To use an analogy that a former colleague of ours once used with me, occasionally the garden of economic growth needs to be weeded for regulation that may not make sense. So without attempting to lecture anybody or be lectured to, I would say that it's not a question so much, again, of regulation or deregulation. It is a matter of smart regulation and dumb regulation, and I think the majority of members today have looked at this provision and have concluded this is not smart regulation, particularly at the time in this economy. I have no expertise on districts outside of my own, but I will just say when I speak to the vast majority of community bankers in my district, when I speak to the vast majority of small business owners in my district, when I speak to the vast majorities of entrepreneurs in my district, they all cite the red tape burden as a major impediment to the expansion, the sustainability, and in some cases the actual survivability of their business enterprise. And I personally am certainly informed by their opinions and take it as a responsibility to listen very carefully to them. Chair yields back. Who seeks recognition? Does anyone have an amendment? There being no amendments without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it.
Mr. Chairman.
Bill, who seeks recognition? Yes, gentleman from Missouri.
I request a recorded vote.
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4554 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4554, to amend the securities laws to improve private market offerings and for other purposes.
Without objection, the bill is considered read and open to amendment at any time. The chair recognizes the gentleman from South Carolina, Mr. Mulvaney, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman, and thank you for bringing this, the Restricted Securities Relief Act, to the full committee for consideration today. As with many of these bills, it is a small but important piece of the puzzle to improve private market offerings and part of an attempt to increase liquidity and access to capital, especially for small businesses and startups. SEC Rule 144 and this bill are probably more important than they seem to most folks. The basic question is, how do we get stock, especially stock in smaller companies, to become more publicly tradable? Because if it's more tradable, it's more liquid. If it's more liquid, there's more demand. If there's more demand, it's easier to raise capital. So the bill does three things to try and change SEC Rule 144 to achieve this goal, which I'd like to discuss in turn. Before I start, I think it's worthwhile to note again, we had a hearing on this several weeks ago, but to note again that all of these changes were recommended by the SEC's Government Business Forum on Small Business Capital Formation 2 years ago. First, the bill reduces the holding period for the sale of restricted securities of reporting companies from 6 months to 3 months. Originally, the holding period was set at 2 years, and that was put in place to make sure that investors had sufficient information before the stock was made available for public sale. Over time, this holding period has been reduced. As the world and the markets are speeding up, it is much easier to get all the relevant information to potential investors more quickly. Further reduction in the holding period time is appropriate. In fact, other countries, not the least of which is Canada, has already made this exact change to 3 months. The reduction would reduce costs and burdens associated with SEC registrations for small emerging companies and bring investors who have fled the private investment public equity market back to the market. Second thing the bill does is to provide shell company relief and allow the public resale of restricted securities originally issued by the shell company 2 years after the shell company files a Form 8K indicating it's no longer a shell. This change would substantially improve the reverse merger market. It would also allow a shell company to be treated the same as a public company after a certain time period. These restrictions are important to protect shareholders when a company is small and emerging, but once the company has grown and is trading, there's a reduced need for these restrictive rules. The provision also removes the scarlet letter a shell company carries after its 2-year period. Finally, the third piece of the bill would reduce the cost and the burden of duplicative registrations with an eye towards investor protection. Currently, duplicate registrations for securities reporting companies are required at both the state and the federal level. Reporting companies, by their very nature, already provide sufficient public information about the companies to the federal level. Even if not done on an individual state-by-state basis, in today's world, this information is readily available and easily available to investors and still provides investor protection with regulatory oversight conducted by the SEC. The reduction in duplicative and costly registrations would save small emerging companies significant time and resources, further allowing them to grow. Mr. Chairman, the Jobs Act made a number of important changes to help small businesses and make the IPO process easier for them. My legislation follows suit by bringing parity to private offerings and the subsequent sale of securities by making the process just a little bit easier. I hope supporting small and emerging enterprises and reducing costs and regulatory burdens are goals we can all support, and I'm looking forward to passing the bill today. With that, I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? Ranking member seek recognition.
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, this bill shortens the holding period under the Rule 144 safe harbor before private restricted securities may be resold to the public for 6 months to 3 months, permits shell companies to also use this safe harbor, and exempts the resale of such securities to mutual funds, hedge funds, and other large investors under Rule 144A from state regulatory review. Mandatory holding periods were recently revised down from 2 years to 6 months after the SEC determined that such a period, as the CFA notes, purchases of restricted securities by the securities as an investment rather than simply to act as distributors of these securities. Further reducing this holding period to 3 months is likely viewed as a mere hiccup to investors, as they will be able to hedge the stock over that period, as one witness explained, dump the stock into the public market to realize the locked-in discount. The bill represents a dramatic change in the securities laws, likely creating the greatest incentive to issue private restrictive securities instead of complying with the disclosure requirements of public offerings. Public companies would now sell their stock PIPE transactions, that is, private investment in public equity, below the public trading price. One witness, Professor John Coffey, testified that public stockholders resent such transactions and they generally lead to a stock price decline. But this legislation would encourage PIPE transactions. I'm urging a no vote. The Consumer Federation of America said that the legislation would make it easier for large, sophisticated investors to profit at the expense of average individual investors, reinforcing the view that the markets are rigged against the little guy. So it's important to note that resales of restricted securities do not support new capital for a company. I would just urge a no vote on this legislation.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentlelady from Missouri seek recognition?
Thank you, Mr. Chairman. I move to strike the last word.
Gentlelady is recognized for 5 minutes.
I speak on behalf of Mr. Mulvaney's bill, H.R. 4554, the Restricted Securities Relief Act. Our economy has been slow to recover, but the challenges we face are not insurmountable. Now is a great time to revisit rules that are no longer useful and remove restrictions that are holding small businesses back. For investors, the U.S. securities markets operates best when there is a robust trading market in a company's stock. As the market for a given stock grows and the liquidity increases, fraudulent stock schemes become less prevalent and investors are better protected. For smaller publicly held companies who want to raise capital in the public markets, one of the biggest challenges is building trading volume and liquidity for their stock. Simply put, the less SEC restrictions placed on a stock, the easier it is to build trading volume. An IPO is one of the best ways to issue unrestricted stock that is immediately tradable. However, IPOs are not always the best option for smaller companies because they can be time-consuming, expensive, and risky. Instead, many smaller companies may choose to issue stock through a private offering, which can be easier to compete and more cost-effective than an IPO. The downside of a private offering is that shares are not immediately tradable, making them less desirable to investors and less conducive to capital formation. Mr. Mulvaney's bill, H.R. 4554, the Restricted Securities Relief Act, would streamline the process by which restricted securities may be resold to the public under SEC Rule 144. It would reduce the length of time an investor must hold the security prior to resale, as the gentleman stated, from 6 months to 3 months. This common sense reduction would maintain investor protection while making private offerings dramatically more attractive to investors and smaller companies seeking access to capital. In addition, the Restricted Securities Relief Act would provide relief from the scarlet letter that companies must bear if they go public through a reverse merger with so-called shell company. Many exciting and legitimate transactions have been completed through a reverse merger with a shell, including Texas Instruments, Jamba Juice, the Cougar Biotechnology, which was sold for $1 billion. To add a black mark to these companies for the rest of time simply because they choose a reverse merger to go public punishes future investors for no good reason. I believe Mr. Mulvaney's bill strikes the right balance by restricting trading in these shares for a period of time that would serve to disincentivize the bad guys. Then it would lift restrictions so as not to punish the good guys, like Occidental Petroleum, which completed its reverse merger in the 1950s and has been going strong ever since. If we are serious about growing smaller companies, we cannot force a one-size-fits-all approach on the way they access the capital markets. H.R. 4554 gives companies flexibility to choose the route that works best for them while providing them the leeway to grow and expand regardless of the path they take. I support the legislation, support its passage, and I yield back.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentleman from Massachusetts seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, on this matter, I agree with the Consumer Federation of America that this legislation would make it far easier for large, sophisticated investors to profit at the expense of average individual investors, reinforcing the view that is so prevalent today that the markets are rigged against the little guy. This bill would do this through the seemingly innocuous step of reducing from 6 months to 3 months the mandatory holding period before the accredited investors and qualified institutional buyers who purchase restricted securities issued by an SEC reporting company could resell them to the general public. This is pump and dump. While the legislation is unlikely to have any beneficial effect on capital formation, it is highly likely to further undermine investor faith in the integrity of the markets. As both Mr. Beatty and Columbia Law School Professor John Coffey noted in their testimony before this committee, reducing the holding period for restricted securities to just 3 months would enable more sophisticated, accredited, and institutional investors to use their access to private offerings to purchase the shares at a discount and then dump the shares in the public markets upon average unsophisticated investors. And regarding the shell companies, which this legislation does, the SEC generally prohibits use of the Rule 144 safe harbor for a company that has ever been a shell company because of concerns of misuse. Recently, shell companies have been used in controversial reverse mergers with Chinese companies, allowing the merged company to go public without complying with the requirements of an IPO. Notably, Section 3 of this bill allows a company to only file a notice that it is no longer a shell, yet places no requirements to file financial information, for example, 10Ks, during the 2-year period. As a result, a company that has not filed any reports will be able to issue private securities that can be resold to the public a few months later. This opens the door to pump and dump. This is bad for average mom-and-pop investors, and this favors institutional and sophisticated investors. We don't need more of that. We're at an all-time low now of adults in America investing in the stock market. It's because they believe, and I think rightly so, that in certain instances the game is rigged against them. So for those reasons, I oppose this bill, and I yield back.
Gentleman yields back. Who seeks recognition? For what purposes the gentleman from Missouri seek recognition?
I move to strike last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I won't go over the different things that the bill covers. I think we've already gone through all that at length, both sides. I just want to reiterate and follow Mr. Mulvaney's earlier lead by trying to do this very briefly, is that, this is a situation where the SEC's own Government Business Forum on Small Business Capital Formation, in the report of 2012, made these recommendations for streamlining and improving the ability of small businesses to have access to further capital and liquidity. And it would seem to me that those people should be in the know to understand how protecting and improving the ability of this capital formation would be. I think that, to me, that's a key point that we seem to be losing here, is that there seems to be the regulators understand the risks that are out there, and yet they are supporting something like this. I think that's something we're forgetting to take into consideration with that. I urge the support of the bill and yield back. Thank you, Mr. Chairman.
Gentleman yields back. Any further member wish to be recognized? Are there any amendments? If not, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it.
Mr. Chairman.
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I now call up H.R. 4568 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4568, to enhance the ability of smaller reporting companies to access the...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentlelady from Missouri, Mrs. Wagner, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. I move to strike the last word. As members of Congress, one of our top priorities is to create an environment where small businesses can flourish and investors are well protected. In fact, we have an obligation in this tough economy to make it easier for small businesses to create jobs by eliminating unnecessary government impediments to growth. I have spoken to many smaller companies in my district who are struggling to raise capital, even in a robust stock market, because of outdated and unnecessary requirements imposed on them by the SEC. The SEC knows about these issues. In fact, it devotes a large portion of its resources to holding forums to solicit recommendations on how it can facilitate small business capital formation. Yet the SEC has failed to act on these recommendations year after year. So I guess it's up to Congress to fight for the little guy. One example of a smaller company that has been left behind by the capital markets is Fuel Performance Solutions, located in my hometown of St. Louis. Fuel Performance Solutions has spent the past 10 years working on a fuel product that promises to save average Americans thousands of dollars at the pump and reduce harmful emissions. Developing breakthrough technology like this is time-consuming and expensive. So Fuel Performance Solutions decided to register with the SEC and become a public reporting company in the hope that this would enable them to raise capital, to commercialize their products, grow their company, and hire more workers. In becoming a public company, they took on SEC reporting obligations. They provided 2 years of audited financials and underwent a full SEC review on their disclosures. All their financial disclosures are posted on the SEC website for all the world to see. Yet, despite complying with all these regulatory hurdles, they do not enjoy the ability to conduct offerings on Form S-3. Short form registration, simply because of their size. They are under $75 million in public float. Fuel Performance Solutions worked out a projection of the huge amount of savings they would realize if they could use short form registration, which they provided to me. Mr. Chairman, I ask unanimous consent to enter this document into the record.
Without objection.
They projected that for a $5 million capital raise, they would save approximately $225,000 in legal, accounting, and investment banking fees if they had access to the S3. What's more, they could receive SEC approval in days instead of months, adding to their certainty and ability to plan for their business. Most importantly, they could raise capital on more favorable terms because Form S3 allows for shelf registration. Under current rules, smaller companies are forced to take a 20% discount on the fair market value of their shares. That's hundreds of thousands of dollars going to the big guys that could have been reinvested back into their growing business to create new jobs and grow the economy. No wonder small business is suffering. No wonder jobless Americans are still struggling. It's time for the SEC to stop neglecting the engine of job growth in America. My bill, H.R. 4568, the Small Business Freedom to Grow Act, would lift these unfair restrictions to allow more companies to benefit from the greater flexibility and efficiency in accessing the capital markets afforded by Form S3. These changes would only apply to companies that are not shell companies and who have been timely in their SEC reporting for at least a year. This would ensure that investors would be protected by up-to-date company disclosures that would be easily accessible via the Internet. For companies that are not exchange-traded, my bill would limit their use of S3 to 1/3 of their public float in offerings over a 12-month period, similar to the way the current cap applies to exchange-traded companies. My bill would also give companies that are traded on a national stock exchange greater access to S3. The exchanges already impose strict quantitative and qualitative listing standards on companies that ensure investors are treated fairly and that companies operate under rigorous corporate governance standards. The current SEC cap provides no additional investor protection. I hope that you all will join me in making these balanced reforms that will make a huge difference for smaller companies struggling to grow by supporting H.R. 4568, the Small Business Freedom to Grow Act. I thank you, and I yield back, Mr. Chairman.
Gentlelady yields back. For what purpose does the ranking member seek recognition?
To strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, I think the first provision of this bill does make some sense and could help smaller companies avoid having to obtain an audit related to a filing that is itself already audited. Now, if that was the totality of the bill, that would be fine. However, the next provision is problematic, and as Professor Coffey testified, it invites potential disaster and investor confusion. What my colleagues on the other side of the aisle seem to forget is that capital formation primarily involves two private sector actors, the company raising the capital and the investor providing the capital. Reducing costs for the issuer by removing either additional disclosures to both existing investors or potential investors only serves to increase the cost of capital investors demand of the company. As a result, such proposals are penny-wise and pound-foolish. While the introduced bill makes some changes from the draft that was considered in subcommittee, it would still allow companies that are traded over the counter or only on the pink sheets could make use of a limited shelf registration with no prior notice. Professor Coffey notes that traditionally, shelf registration was limited to seasoned issuers with a sizable market capitalization and an established market following. However, pink sheet companies are the complete opposite. The Consumer Federation of America wrote a letter stating that the most likely and perhaps the best outcome if this legislation is adopted is that the market simply will not accept such offerings, and thus it will do nothing to promote capital formation. I would note that Ms. Wagner has worked to address some of the concerns raised by several of the Democratic witnesses, including removing the ill-advised preemption of state law. For these smaller companies, the state regulator serves as the cop on the beat, assisting their constituents and enforcing the securities laws in instances where the SEC may be overwhelmed. However, the CFA goes on to say that even with the protection of state oversight, this bill increases the risk of fraud and misconduct without offering any benefits to justify that added risk. So for all of these reasons, and for the fact that we should be spending our time working on legislation to reauthorize the Export-Import Bank and the Terrorism Risk Insurance Act, I urge a no vote. The balance of my time.
General Leader yields back. For what purposes does the gentleman from South Carolina seek recognition?
Move to strike the last word, Mr. Chairman.
Gentleman is recognized for 5 minutes.
A housekeeping matter first, Mr. Chairman. I ask unanimous consent to place into the record the following letters of support for this act. Letters from the Biotechnology Industry Organization, Fuel Performance Solutions Incorporated, the NASDAQ OMX, Richardson and Patel, Securities Industry and Financial Markets Association, and the U.S. Chamber of Commerce.
Without objection.
Thank you. And I think it bears noting, Mr. Chairman, that there's another group that supports this, in addition to the ones that I just read, which is the SEC itself. The SEC asked for this change in 2007. Its advisory committee did that, and its small business forum has asked for this change every year since then. So I recognize the fact there may be some groups that oppose it, but I mean, if this administration wants it, and there's folks on this side of the aisle want it, isn't this one of those things we should be able to agree on a bipartisan basis? When you boil it down, it seems that it does two primary things. It lets all companies use Form S-3. If it's good enough for some, why wouldn't it be good enough for others? I've failed to see the argument as to why. What is it about certain companies that says, okay, they're not going to satisfy, they're not good enough to use Form S-3? I would be curious to know what the objections are. That maybe we could talk through that a little bit.
The gentleman yield?
I'd be happy to.
The gentleman yield. Just on one point, the
Sure.
gentleman said that in 2006, this SEC, this administration supported this. That was the Bush administration that supported this. The Obama administration SEC has not supported this measure. The gentleman just misstated.
Well, I'll reclaim my time. I appreciate that. My notes indicate it was in 2007, which you're right, would be the Bush administration by its advisory committee, but that it, and just to be clear now, and has been recommended by its small business forum each year since. So I understand what Mr. Lynch is saying, and I agree that it was the Bush administration in 2007, but this seems to be the type of thing that the SEC likes regardless of who's running the place. To the second point about allowing this incorporation by reference, the future SEC filings on Form S-1, does anybody really object to this? I mean, cutting and pasting and incorporating by reference is something we do in our offices every single day. Everything we're reading today has been cut and pasted from someplace else and incorporated by reference. Is there really danger to the consumers from doing that? I understand there's objections writ large to some of the things that are happening today, but I'm still hard-pressed and would welcome specific explanations as to why what Ms. Wagner is trying to do harms consumers. With that, I will yield back the balance of my time.
Mr. Speaker, Mr. Chairman, unanimous consent to place some opposition into the...
The gentlelady is recognized. Well, without objection.
Yeah, thank you very much. The gentleman asked for objections, and I have quite a few. I'd like to submit into the record opposition from the North American Securities Administrators Association, Public Citizen, the Council of Institutional Investors, and the Consumer Federation of America.
Will the gentlelady yield?
Yes.
I recognize that. I recognize there's groups that are listen, there's groups that support everything we do and object to everything you do, and there's groups that support everything you do and object to everything we do. I get that. My question is, what's the objection? What is it about incorporating by reference on Form S-1 that is going to make our markets less safe and subject individuals to greater risk? What is it about allowing more companies to use Form SE3 that does the exact same thing? I understand there's objections on philosophical basis because some people just don't like us, and I recognize the fact that works both ways in this business. My question is, what are the...
Reclaiming my time, this certainly is not about someone liking or disliking someone, and I certainly would not like to have these very credible organizations defined that way. These are well-established, respected organizations that have opposition, and I submit to you that they will be available for you to review and read if you would like. to find out their objections in detail. But for now, I would submit them for the record. I yield
Without
the balance
objection.
of my time.
Who seeks recognition?
That was an extended use.
Okay. For what purpose does the gentleman from Massachusetts seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. In response to the gentleman's queries as to what dangers are there, first of all, I want to point out that the Small Business Advisory Council is not part of the SEC, so the statements and the positions attributed to the SEC because of what the SBA, the Small Business Advisory Council, stated is not correct. They offer advisory opinions to the SEC, but that is not the SEC. That's an advocacy group on behalf of small businesses. So just wanted to correct that. The problem with what is being proposed here is that this legislation would permit any company that is not a shell company to use shelf registration and issue securities without providing advance notice or updating its prospectus. That shelf registration system was actually designed for seasoned, widely traded companies that are in the media all the time. We know a lot about them. That's why we did that carve-out for shelf registration, because investors had that information, just had very easy access to that. There was a long history with these companies. They're widely traded. We know a lot about them. But what this bill does is that it allows that shelf registration to be used by small companies, including companies that trade in pink sheets or on the OTC bulletin board that we know very little about, that have very little news in the media, that investors know very little about. They don't have any of the characteristics that we carved out that exception for. That's the danger. Much less information in the hands of the investor. That's the danger. It's fraud. That's the danger. Misleading people. That's the danger. So when you think about what's the danger of this, there it is. Just it's a more opaque system. It's much more easy to game the system on the part of a small company that there's not much information about. It doesn't provide the same protections that we would normally require under the same circumstances.
Would the gentleman yield?
Not right now. Maybe when I get down to it. I just want to make sure I say everything I have intended to say, but I appreciate it. Now, in terms of the gentlelady who's sponsoring this, I do want to say I do appreciate that she put back in state regulation. Originally, when we discussed this draft earlier, not only was the shelf registration there, but also the bill proposed taking away the ability of the state to police this. So I've got to give credit where credit is due, and I thank the gentlelady for putting state regulation back into this provision. And I appreciate that, and I'm sure the state regulators do as well. But as Professor Coffey said before this committee when this came up before, he said this could invite fraud and misconduct, and indeed, even with the protection of state oversight, this bill increases the risk of fraud and misconduct without offering any benefit to justify that added risk. That's the truth about this, plain and simple. I now have a minute and 30 seconds left, and I'd like to yield to the gentlelady who asked for time.
I thank the gentleman very much. The SEC added the exchange-traded requirement in the final rule as a safety measure, but in their proposing release, they said it was temporary and that they would consider expanding it if there was, in fact, no investor harm. It's now been 7 years later, and no investor harm has been raised. However, plenty of harm to small businesses and to job growth has been raised to the SEC in public forums year after year. I think it's time to make the expansion of the SEC originally proposed with a one-third cap in order to make them meaningful. We know that all public companies, regardless of size, are making...
Okay, I'm going to reclaim my time. I think you're editorializing now. I appreciate your point, but we have raised investor concerns. The investors will not have the same information because we're using shelf registration on companies that have very little history, that are not widely traded, that we have very little information about. That's the danger here. And with that, I yield back the balance of my time. Thank you.
Gentleman yields back. Chair now recognizes himself for 5 minutes. I'm listening carefully to the debate, and I listened very carefully to what my colleagues on the other side of the aisle have to say. I took careful note, although he's not here, the gentleman from Connecticut, when he spoke in terms of striking a balance with regulation. And I'd remind many of my colleagues that the SEC has a three-part mission, and I'm sure that occasionally they have to balance that. Part of that mission has to do with capital formation. And so I know the gentleman from Massachusetts said that the passage of the gentlelady from Missouri's bill could risk fraud. Well, number one, fraud is fraud, whether it's incorporated into Form S3 or not. It is actionable. It is criminal. I certainly don't believe I agree with that, with the gentleman's assertion, but I would also suggest that the legislation actually increases the risk that people might get a job who need a job, because capital formation is facilitated by a small yet modest
Will the gentleman yield?
I'll yield briefly to the gentleman from Massachusetts.
But it's a two-part equation here in terms of capital formation. Sure, the company is raising capital, but also there's a cost when the investor says, I don't know enough about this company, so that I'm going to raise what I have to get back, the interest I have to get back because of the risk here, because the lack of information. And that's a drag on capital formation in a very real sense. It's costing them more because they're providing less information.
Reclaiming my time,
Sure.
I think perhaps now the gentleman may be editorializing just a bit. I'm glad to hear the gentleman use the phrase capital formation. I'm not sure I've heard the gentleman use the phrase in this markup or perhaps other markups, so I'm glad to find it is a genuine concern of the gentleman from Massachusetts. But again, in trying to strike this balance, and this is true of many of the bills that will come before our committee today, I would remind each of our colleagues, 1/6 of our country is currently on food stamps. That is not a measure of a successful economy. My guess is most of these families would prefer to have a paycheck and not a food stamp. And so when we think in terms of this balance, maybe we want to make it a little easier for the small businesses, the job engine creator in our nation, to help create those jobs. We know that we just had, again, as I said in my opening statement, almost 1 million people leave the labor force. They give up. They just give up. I hear from some in my district frequently. I hear from a Joe of Garland, Texas, who I've had the privilege of representing in Congress. I was laid off with other senior coworkers in late 2009. Since that time, I've not been able to find any employment in the wood or construction projects or other related industries. I have sent out 1,500 resumes. So I understand about the passion in caring for the investor, and we should. But there's also a balance in this regulation. And we also have to care about the unemployed and the underemployed who are desperately seeking work. And we know also our economy in the last quarter barely had a pulse, barely fogged a mirror, 0.1% GDP growth. I think this is a very modest approach by the gentlelady from Missouri, and with my remaining 30 seconds, I'd be happy to yield to the author of the legislation.
I thank the chairman. I also want to remind my colleagues that we know that all public companies, regardless of size, are making adequate disclosures that are easily accessible via the SEC website for all to see. So in terms of investor protections, in terms of transparency, that information is out there and disclosed in this modern age. We absolutely need to allow non-exchange traded companies to also have access to this tool for small business growth. We owe it to the thousands of Americans searching for jobs. We owe it to America's job creators. I thank the gentleman for yielding.
My time has expired. Who seeks recognition? Are there any amendments? If not, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it.
Okay, is this the first?
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I now call up H.R. 4571 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4571, to direct the Securities and Exchange Commission to revise its rules.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Illinois, Mr. Holmgren, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. I ask unanimous consent to introduce an amendment to our bill to name the short title of our bill, the Encouraging Employee Ownership Act of 2014.
Without objection, the amendment is adopted.
Today I'm proud to speak in support of H.R. 4571, the Encouraging Employee Ownership Act of 2014, or EEOA. I introduced the bill along with Representative Baucus, Fitzpatrick, Garrett, Hurt, Mulvaney, Ross, and Stivers. The EEOA would make it easier for companies in Illinois and nationwide to let hardworking employees own a stake in a business that they're part of. I've learned firsthand from my constituents in the 14th Congressional District of Illinois about the many benefits of employee ownership. When you walk into Scott Forge, an entirely employee-owned manufacturer in my district, there is a noticeable difference in the energy of the employees, from upper management down onto the shop floor as well. Metal workers and machine repair technicians take pride in their work, knowing it contributes to their share in the business. When employees have a stake in the company they work for, their sense of ownership over details, large and small, make a real difference to the bottom line, and, as importantly, their quality of life. The business, in turn, receives a large boost in productivity, enabling them to expand their reach and invest in new technologies and equipment. Companies like Scott Forge have shown me that ownership incentivizes the extra effort to achieve great success so that employees can earn the large upside that comes when they perform well. This benefit helps companies attract top talent even if the company is just starting out. David Miller, President and CEO of the Illinois Biotechnology Industry Organization, which represents companies that employ thousands of residents in my district, believes that making it easier for companies to offer employee ownership helps Illinois businesses expand and hire more workers. He said, and I quote, "As someone who has worked in technology for most of my career, I know that affording an ownership stake to employees is critical to recruiting top talent to job-generating companies. And there is no doubt that an equity stake encourages employees to drive hard for the success of the enterprise," end quote. Unfortunately, some companies are shying away from offering employee ownership because of regulations that limit how much employee ownership they can safely offer. SEC Rule 701 mandates various disclosures for privately held companies that sell more than $5 million worth of securities for employee compensation. In 1999, the SEC arbitrarily set this threshold at $5 million without a concrete explanation for why investors would experience difficulties with sales above that number. For businesses who want to offer more stock to more employees, this rule forces those businesses to make confidential disclosures that could greatly damage future innovations if they fell into the wrong hands. This required information includes business-sensitive information, including the financials and corresponding material like future plans and capital expenditures. The SEC's original rulemaking acknowledged this, and some voiced their concern that a disgruntled employee could use this confidential information to harm their former employer. Leaving aside the risk involved in disclosing this confidential information, it is costly to prepare these disclosures just so a business can offer the benefits of ownership to their employees. The Encouraging Employee Ownership Act would address this problem and open up more opportunities for employees to share in the companies they work for every day. EEOA builds off the Jobs Act reform to Rule 12G, which increased the number of shareholders of record that a company could have without SEC registration from 500 to 2,000 and exempted employee compensation securities from the registration requirements. This idea, championed in the Jobs Act, that the law should treat employees' compensation securities differently than traditional securities, has not been extended in SEC Rule 701. My bill is simple: a bipartisan fix to that changes that problem. EOA amends SEC Rule 701 to raise this disclosure threshold from $5 million to $20 million and adjust the threshold for inflation every 5 years. To be clear, issuers that are exempt from disclosure would still have to comply with all pertinent anti-fraud and civil liability requirements. And the employees purchasing these securities observe the businesses they work for every single day and have a closer perspective on its operation that is not available to the traditional investor. Support for this effort to improve the utility of Rule 701 can actually be found in SEC's own Government Business Forum on Small Business Capital Formation final reports from 2001, 2004, 2005, and 2013. As the Chamber of Commerce, which supports this legislation, has explained, this legislation would help give employees of American businesses a greater chance to participate in the success of their company. Setting the threshold at $20 million would ensure that Rule 701 remains a viable provision for businesses to use in the future and decrease the likelihood of unnecessary regulatory requirements. We should applaud employee ownership, and I ask for support of this measure. I yield back.
Jim Moon yields back. For what purposes the ranking member seek recognition?
To strike the last word.
Gentlelady is recognized for 5 minutes.
Well, Mr. Chairman, I thought today's markup was going to be about legislation that actually facilitates capital formation. However, this bill doesn't appear to have anything to do with that goal. Instead, all this bill does is restrict the amount of information that a private company must furnish an employee in the event they're compensating that employee with stock. If a private company provides more than $5 million worth of compensation in the form of stock over a 12-month period, the company must make relatively simple disclosures to that employee, including 2 years of financial statements, which don't even need to be audited, and information about the risk associated with investment in the securities. The SEC adopted the $5 million threshold in 1999. Now, it may be reasonable to update that number in order to account for inflation, but $5 million adjusted for inflation since 1999 only amounts to about $7.1 million. It seems as if quadrupling the threshold to $20 million may be going too far and is not based on any empirical analysis. As Professor John Coffey of Columbia University noted in our April hearing on this bill, this proposal to raise the exemption by 400% seems hard to justify. Moreover, Professor Coffey notes that once the sale of securities under Rule 701 exceeds $5 million and begins to approach $20 million, the cost of providing disclosures falls as a percentage of the total transaction anyway. I think, some proponents of this bill note that disclosure by companies of this information to employees runs the risk of the leakage of confidential information. Okay, I understand that concern, though I think that it would be better addressed through non-disclosure agreements rather than denying employees the right to understand how much their compensation is worth and what the risks associated with that compensation are. Finally, Section 502 of the Jobs Act make it easier for privately held companies to remain private by exempting employees who receive stock as a result of a compensation plan from the count on holders of record, among other provisions. Given that the ink is barely dry on the Jobs Act, I'm not sure we want to go further and extend Rule 701 cap to $20 million, thereby creating even further incentives for companies to avoid job-creating IPOs instead of remain private. In conclusion, Mr. Chairman and members, I don't understand resistance to transparency. I just don't get it, why a private company would not want to disclose some very limited and basic information so that employees who may think they would be getting one thing end up finding that they have traded raises for stock that's not worth anything. So, why do that to employees? Why don't we just give them the information? I yield back the balance of my time.
Gentleman yields back. For what purposes, gentleman from Pennsylvania seek recognition?
Move to strike the last word.
Gentleman is recognized.
Thank you, Mr. Chairman. I'd also like to congratulate Mr. Holmgren on this really thoughtful approach to the thresholds of Section 701, designed to address a couple of important objectives. Number one, raise the threshold to 20 million, which it sounds like even the other side, the ranking member, acknowledges there needs to be some update. But number two, and perhaps just as importantly, to tie it to some sort of an economic index or inflationary index. Too many times in this town, Congress acts, they act appropriately, but they don't look back for many, many years. We dealt with this issue in a different vein last summer when we tied student loan interest rates to the 10-year Treasury bill, which was long overdue, and took political, took the issue out of the politics of Congress and put it to something that made some sense in the economy. Now, Mr. Holmgren talked about how he hears about this back in his district. I hear the same thing on this issue. In my district in Bucks County, Pennsylvania, there's one company, I've met with them, they have a representation in my district, which is Wegmans Supermarkets. They're a 100-year-old business, family-owned grocery store, very popular with the customers. The customers love them. The employees love working for the company. Fortune 500 has been keeping track of satisfied employees and what companies they most would want to work for. And Wegmans has been on that list every single year since 1998 when it went into effect, right near the top of the list. And so, they're doing the right things, but they're being required. And this is a company that in this economy is trying to transfer some of the ownership of the company to the employees, which is a wonderful thing for the employees, obviously, probably part of the reason those employees so value working for Wegmans as an organization. But the company is being required to enter into a sort of no-win situation. Do they transfer ownership interest in the company to the hardworking employees of the organization? Or, if the other alternative is sort of risk disclosing confidential information, which they're required to as a condition precedent to providing that information. We should not be putting the companies in that position in this economy or in any economy. So I just wanted to sort of echo the comments, the opening statement of Mr. Holmgren. I hear it not just with respect to Wegmans, I hear it with respect to biotechnology, startup organizations in my district as well, the exact same issue. So I want to congratulate Mr. Holmgren on the bill. I'm proud to be a co-sponsor, and I encourage my colleagues to support it. Yield back.
Gentleman yields back. Who seeks recognition? Are there any amendments? If not, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the bill is reported favorably to the House.
I'll ask for a recorded vote.
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4569 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4569 to require the Securities and Exchange Commission to make certain improvements.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from New Jersey, Mr. Garrett, the chair of the Capital Markets Subcommittee and the sponsor of the legislation, for 5 minutes.
I thank the chair, thank the members of the committee for listening to this. This is probably one of the simpler bills that we will have up. Mr. Mulvaney is shaking his head no, that it isn't, but actually goes along the lines that he was talking about on some of his legislation, that we will, to the, in the words of the ranking member, can we continue to provide the information to the public? We will be. We're just summarizing it on the front page, the summary page. So what H.R. 4569 does is direct the SEC to simplify its disclosure documents regime for issuers and investors by permitting the issuers to submit a summary page on Form 10K, and then that summary page would simply have cross-references to the contents of the report. So all the information is still there. We're just providing a simple summary page. Why do you do this? Well, because the typical 10K filing by an issuer is often hundreds of pages long, and investors have told us that sometimes when it's so long, it's sort of difficult to dig through and find all of the information that they need or want. They can find it, it's just hard to do. So we're simply saying, SEC, can you come up with a summary page that will enable investors to more easily access the most relevant information that they are looking for. One other thing that it will do is also direct the SEC to revise the SK forms to scale. Basically to scale disclosure rules for emerging growth companies and smaller issuers. Again, it's to make sure the information is there but is not duplicative or outdated or unnecessary. So if we can tell them to eliminate that sort of thing, then the information that is there will all be the up-to-date information that the investors are looking for. In addition to these revisions, we're asking for a study. We're asking for the SEC to do a further study of Reg SK and engage in rulemaking to implement additional forms once they do their study to simplify and modernize Reg SK disclosure rules within the 360 days of enactment of this Act. And with that, I will yield back to the Chair.
Gentleman yields back. Who seeks recognition? For what purpose does the gentlelady from New York seek recognition? Gentlelady has an amendment at the desk. We will pause and allow the amendment to be distributed. Okay, this is already agreed to. And we're good with this. We'll take it by voice then. Is there any member who has not received a copy of the amendment? If not, the clerk will report the amendment.
Amendment offered by Mrs. Maloney, page 2, strike lines 7 through 19. And
without objection, the amendment is considered read. The gentlelady is recognized for 5 minutes to explain her amendment.
Thank you very much, Mr. Chairman, and thank you, Mr. Garrett, on your work on this. When we marked up the Jobs Act in 2012, the chairman of the Capital Markets Committee, Mr. Garrett, included an amendment requiring the SEC to conduct a study on how to modernize and simplify the disclosure process for emerging growth companies. The SEC published that study last December. While the study failed to make any specific recommendations for how to streamline the disclosure process, it did provide a fascinating history of all the different efforts to simplify the registration and disclosure process, especially for smaller companies. For example, there was the SEC's 1969 Disclosure Policy Study. Secondly, the 1977 Advisory Committee on Corporate Disclosure. Third, the Simplified Form S-18 for small companies adopted in 1979. 4, a new Simplified Form SB in 1992. 5, the 1996 Task Force on Disclosure Simplification, the 2005 Advisory Committee on Smaller Public Companies, the Advisory Committee on Improvements to Financial Reporting in 2007, and most recently the Advisory Committee on Small and Emerging Companies. What this history demonstrates is that the process of scaling and streamlining the reporting requirements for smaller companies is something that, in order to keep pace with the ever-evolving marketplace, has to be revisited every 7 to 10 years. It requires a strong oversight from the SEC and from Congress. And I believe that now is an excellent time for the SEC to revisit the disclosure requirements for smaller companies and to figure out how to best modernize them. This bill directs the SEC to build on its 2013 study by making immediate improvements to Reg SK in the short term, and then by making specific detailed recommendations on how to simplify and modernize Reg SK in the long term. My amendment simply clarifies that the first rulemaking only applies to the low-hanging fruit, in other words, improvements that the SEC has already identified and does not need to study anymore. My amendment also clarifies that the revisions in the first rulemaking have to reduce the burdens on small companies, but they also have to ensure that investors will still get access to all material information. Finally, my amendment requires the SEC to consult with the Investor Advisory Committee, as well as the Advisory Committee on Small and Emerging Companies, during their study of Regulation SK. This will reduce the burden on small companies while still ensuring that investors have access to the information they need to make investment decisions. I think that this helps direct and streamline and helps the overall bill. I would like to thank Chairman Garrett for his work on this bill and for his leadership in this area, and I urge my colleagues on both sides of the aisle to support, and I yield back.
Lady yields back. For what purposes? Gentleman from New Jersey seek recognition.
On the amendment?
A gentleman is recognized for 5 minutes.
So just a couple of points. First of all, I thank the gentlelady from New York for working with us on this legislation. I should also thank the gentlelady's staff as well for working with our staff on this legislation. Secondly, I would like to make the point that I think you make a good observation from digging through the report that you just said. That was sort of interesting as far as the time frame. I thought of every half a dozen or 7 years that they have to make a review. And then I'm just going to sort of carry through this when you were saying that they have to do the review, and so do we. And so that's why it's apropos that we have to come on every so often like we're doing right now and suggesting that they update their regulations on it. So I appreciate those those observations. I think they were good, and I also appreciate the language that you have worked together with us on for this underlying bill. And so I would encourage a yes vote on the amendment and a yes vote on the underlying bill. So thank you.
Gentleman yields back. Who seeks recognition? Are there any amendments to the amendment? If not, the question is agreeing to the amendment. All those in favor say aye. Aye. All those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is agreed to. Who seeks recognition? Are there any amendments? Without objection, the previous question is ordered. The question occurs on reporting the bill as amended favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the bill as amendment is ordered, reported favorably to the House. The gentleman
request a recorded vote.
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4570 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4570 to direct the Securities and Exchange Commission to revise Regulation D.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes once again the gentleman from New Jersey, Mr. Garrett, chair of the Capital Markets Subcommittee and the sponsor of this legislation for 5 minutes.
Okay, so we're on a roll here. So this is another common sense piece of legislation, the Private Placement Improvement Act. So what does this bill do? This legislation will ensure that issuers and investors in certain private offerings under Reg D, Regulation D, do not face, just like with the other situation, overly complex and burdensome regulatory obstacles. Last year, the SEC adopted a rule lifting the ban on general solicitation and advertising in private offerings under Rule 506 of Reg D. And that was why they do that. That was mandated by Title II of the Jobs Act, which most of us supported. Unfortunately, the SEC didn't stop there. Instead of simply removing the ban and opening up this market, which is what the Jobs Act required, to all new potential investors, the SEC also decided to issue a separate rule proposal not called for by Congress that would impose a number of new and burdensome regulatory requirements on issuers seeking to use Rule 506. You see, the SEC's selective judgment in deciding just when and how to follow clear congressional directives and when not to is disconcerting to me. When members of the committee, outside stakeholders, and even other SEC commissioners pleaded with the Commission to issue a more pragmatic rule regarding conflict minerals, the Commission refused in that case, stating, quote, "If Congress had intended that, a mandate may be limited further. We think Congress would have done so explicitly," end quote. But unfortunately, the Commission did not apply that same rationale in a consistent manner when it came to the removal of the ban on general solicitation in the Jobs Act. As one comment put it, quote, "The Jobs Act on its face, does not authorize the Commission to attach new and additional conditions to the use of the exemption, and it is not for the Commission to rely on its general rulemaking authority to bring Congress and the President, quote, back into line by adding conditions that it believes may enhance investor protection, end quote. However, that is exactly what the Commission had done. That the SEC believes that it has the authority to alter a clear mandate in the Jobs Act, a bill that came out of this House with strong support in the Senate and signed by the President, but not in the Dodd-Frank Act, certainly suggests that the SEC is more comfortable faithfully executing the will of Congress when the means imposing burden regulations on American businesses and investors as opposed to removing them. Indeed, I believe that many of the additional requirements in the SEC's Reg D proposal will, if ultimately adopted, make Rule 506 a less attractive avenue for small business capital formation and harm investors' choice. This is clearly at odds with the goals, let alone the text, of the Jobs Act. And so, the legislation before us would address some of the more burdensome red tape contained in the SEC's rule proposal, including certain costly filing requirements and disqualification provisions. Before I conclude, Mr. Chairman, I would like to be clear on a few points regarding what this legislation would not do. It would not remove the SEC's existing Form D filing requirements, still there. It would not remove the SEC's existing requirements that issuers take reasonable steps to verify that investors in 506 offerings are accredited, still would. It would not reduce the SEC's existing rules requiring disclosures to investors, they remain. And it would not limit the SEC's existing authority to prevent and punish fraud and other misconduct under the federal securities laws, still in place. I believe this legislation will ultimately strike the right balance between helping jobs creators in America raise much-needed capital and protecting Americans who invest their hard-earned money in these same companies. And with that, I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition?
Move to strike the last word.
Gentlelady is recognized for 5 minutes.
The SEC has taken modest steps to address investor protection concerns after Congress, in the Jobs Act, lifted the prohibition on general solicitation and advertising for Rule 506 offerings. Before the Jobs Act, this prohibition had been in place for 80 years. Democrats have made a good faith effort to modernize Rule 506 with the Jobs Act, but before the ink is even dry, the majority is trying to force the SEC into backing down on these very reasonable and minimal investor protections. The private market is quickly surpassing the public market. We need modest investor protections in place in this arena. The volume of Rule 506 offerings in the market in 2012 was $898 billion, while registered offerings total $1.2 trillion. These figures would show that private offerings are about on par with registered offerings, came even before the prohibition on general solicitation and advertising was waived. NASA, that is, the Organization of State Securities Regulators, noted that this bill represents an assault on the authority of the SEC to provide basic reasonable investor protection. Specifically, the legislation's primary purpose appears to be to eviscerate the few investor protection components the SEC has either adopted or proposed related to Rule 506. This legislation is seeking to undermine very reasonable investor protection concerns raised by many stakeholders. In fact, the first official action of the SEC's nonpartisan, broadly representative Investor Advisory Committee was to adopt unanimously a set of recommendations designed to ensure that investors in private securities offerings under Rule 506 receive adequate and appropriate protections. Unfortunately, the SEC moved forward with their rulemaking lifting the prohibition on general solicitation before these additional investor protections were put in place. This bill is an attempt to stop them from moving forward with very modest attempts to protect investors in this market, which largely operates in the shadows. The Garrett bill seeks to make this market more opaque. The Garrett bill guts the SEC's ability to enforce compliance with the law. The SEC's proposed rule is reasonable. It simply says if you don't play by the rules, you don't get to receive this exemption moving forward. This legislation would prohibit the SEC from seeking written advertising materials of issuers using general solicitation. The Garrett bill would allow hedge funds using the Rule 506 exemption to offer misleading performance data. And also, the SEC has proposed changes to Rule 156, which would require private funds like hedge funds that use general solicitation to develop rules literature that is neither fraudulent nor misleading. The SEC is seeking to establish a level playing field with regard to performance reporting between registered funds like mutual funds and private funds, particularly in light of the fact that general solicitation and advertising is now permitted. If we're going to allow hedge funds to release 30-second ads and billboard advertisements, there ought to be basic guidance on how they report their performance to investors. In their proposing release, the SEC notes that, quote, based on the Commission's regulatory experience with investment company sales literature, this area has proven to be particularly susceptible to misleading statements, quote, unquote. I yield back the balance of my time. I ask for a no vote on this bill.
Gentlelady yields back. Who seeks recognition? For what purposes, gentleman from Virginia seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I would urge this committee to support this good legislation offered by Chairman Garrett. As we all know, the legislation that was adopted in 2012 relating to the Jobs Act, or as a part of the Jobs Act, removed the ban on general solicitation and advertisement. And what we got instead was a new rule from the SEC that makes it more difficult for private companies to raise capital in these limited private offerings by accredited investors who are sophisticated in nature, and I think on the grand scheme of things make the job for the SEC in terms of its mission of investor protection easier. The purpose of the Jobs Act in 2012 was, of course, to encourage investment and encourage private sector job growth. I can tell you that representing Virginia's 5th District, where we have places in our district where we still have 10% unemployment, 10% unemployment in rural Southside Virginia. There's some places that have seen unemployment as high as 25% over in the southwestern part of our district. Job creation couldn't be more important, and this measure, which was the Jobs Act, was a bipartisan measure to help encourage that, and that's what we need to be doing. That would be my first point. The second point that I would make really deals with having the SEC stay in its lane. When you look at the amount of regulatory rulemaking that takes place in Washington, and you consider the fact that really under Article 1 of the Constitution that should be the province of Congress, it seems to me that when Congress, in a most bipartisan way, makes these changes to the Reg D exemption, when we make those changes, our intent is clear. It is not good. It is not good to have the SEC come in and make changes that are inconsistent with that congressional intent. So it seems to me that anybody who is a sitting member of Congress who cares about the distinction between the Article 1 branch of government, the legislature, and the Article 2 branch, the executive, should care very much about making sure that we make policy and that policy be followed. So with that, I would yield back the balance of my time. I would encourage my colleagues to support this good measure.
Gentleman yields back. Who seeks recognition? The chair recognizes himself for 5 minutes. I appreciate the gentleman from Virginia's comments, and I think he makes very important comments. Again, I get concerned, particularly when there a trend, a troubling trend where I believe that Congress is increasingly outsourcing its own job to regulators. This is not a good thing. Congress has spoken, and in one of the few occasions spoken strongly in a bipartisan manner on the Jobs Act, something that the President, who I rarely but occasionally find common ground with, called a game changer. The evidence is already mounting that notwithstanding the fact that the SEC has moved slowly and occasionally tried to reverse or undermine the will of Congress, increasingly the evidence is mounting. And I agree with the President that it is a game changer. We are seeing signs of increased activity at the margins, and I think a number, and at least part of the reason, is due to what has happened in the Jobs Act. So when we have the Securities and Exchange Commission overtly reverse what is the clear intent of Congress, this should be incredibly troubling to members of both sides of the aisle, regardless of whether they supported the Jobs Act or not. So that would be the first point I would make. The second point I would make, and I know the ranking member said the ink was barely dry, and now the gentleman from New Jersey is offering this bill. I'd say the ink is barely dry on the Jobs Act when the SEC is attempting to reverse it. I would also bring to the attention of the committee that Rule 506 of Reg D has to do with accredited investors who should have proper disclosure, who should be protected from fraud, but we're dealing with folks who in many cases are sitting on seven-figure plus net worth, or they wouldn't be an accredited investor in the first place, because we know there's a net worth test, there's an income test. Most of these people are sophisticated investors, and at a time where, again, millions, tens of millions remain underemployed, unemployed, have trouble sleeping at night, wondering how they're going to make ends meet, how they're going to pay the bills. If we're looking at a question of balance, maybe we ought to err on the side of those who are unemployed, like James of Winsboro, Texas, who I represent in Congress. Talks about he and his wife, quote, "We are self-employed in the construction business. The past 2 years have been the hardest we went through. Last month, in January 14th, we worked only 6 hours. We are selling things to make ends meet." So I want to make sure that the millionaires have proper investment protections, but at the moment I'm a little bit more concerned about James in Winsboro and his wife, and the fact that recently they only worked 6 hours in an entire month. Again, my colleagues, capital formation. I don't care what the small business is. I don't care if it's a kid with a paper route. Somebody had to invest capital in the bicycle to throw in the newspaper. Or like many of us who mowed lawns. Somebody had to invest capital in the mower to mow lawns. And it just seems like on every single bill that's being presented here, there is pushback from having our job creators have the ability to put people in America back to work. So I would hope that we would take enough pride in our positions as members of Congress to quit outsourcing our own jobs. And when we have agreed on a bipartisan manner, when we have let the will of Congress be known, that we actually expect the regulators to follow that will. And so, again, I want to thank the gentleman for Virginia for his comments. I want to thank the gentleman from New Jersey for offering this important piece of legislation that will help put people back to work and will respect the prerogatives of Congress. I yield back. Who seeks recognition? Are there any amendments? If not, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those. For what purpose does the gentleman from Massachusetts seek recognition?
Move to strike the last word.
Okay, the gentleman's a little late, but I'll recognize him. The gentleman from Massachusetts is recognized for 5 minutes.
Well, thank you, sir. I appreciate it, Mr. Chairman. Mr. Chairman, this piece of legislation, the Garrett bill, seeks to make this market more opaque than it already is. Currently, issuers are required to file a Form D within 15 days of the first sale of securities, and because general solicitation and advertising exposes so many more investors to these offerings under the SEC's follow-on proposed rules, issuers would be required to file a Form D no later than 15 days in advance of the first use of general solicitation. So the SEC is trying to gather information on these private placements. If they don't receive information until the sale, they have no ability to influence or to provide oversight on the solicitations to the general public. That's the problem with Mr. Garrett's bill. It puts the regulation in place after the horse is out of the barn, so to speak. So if a company goes out there with fraudulent or misleading solicitations to the general public, that goes unaddressed by the SEC, number one, because there's no filing requirement until they actually begin to sell. So they can pump all this false information out. They're not required to file a Form D until they actually start to sell, which is too late, because people are going to be asking the SEC early on when these solicitations come out, when these advertisements come out on the radio, on the TV, on the Internet. That's when the questions will come to the SEC. Is this outfit legit? This is a private placement here. Okay? So that's when the SEC needs to respond to the solicitation. What Mr. Garrett does is he puts the requirement to file a Form D when the sale starts. So that's too late. The casual investors are already being taken at that point. So it basically makes the SEC intervention ineffective. The other thing as well is that Mr. Garrett's bill takes the penalties away for not filing a Form D. So if a company just says, well, we know that's the recommendation, but we're not going to do it, which is sort of the situation right now, then there's really no teeth behind the SEC in terms of penalizing a company that doesn't file a Form D. So this is another measure, and I still can't figure out how we're creating jobs by providing less information to investors. I don't make that connection. I think it's more likely that we hurt the markets when we allow their credibility and integrity to be questioned, which is what we do when we create these opaque markets. And this is another one of those examples. So I think this is a very bad bill. This provides less information. I think that the SEC has it right. I think that we try to make reasonable adjustments in the Jobs Act, but this is before we can even respond to implement some investor protections in response to the flexibility we provided in the Jobs Act. We're already eliminating any investor protections that could be provided under 506, Rule 506. So it's unfortunate. I thought we were making progress on the Jobs Act, but I could see that this has led to even less protections for investors, and I think that's very unfortunate. With that, and I'm going to oppose this bill, and I recommend members that they also oppose it, and I yield back the balance of my time.
Gentleman yields back. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay.
Nay.
In the opinion of the chair, the ayes appear to have it. The ayes have it, and the bill. A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I now call up H.R. 4565 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4565 to amend the securities laws to improve the small company capital formation provisions and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from North Carolina, Mr. McHenry, the chair of the Oversight and Investigation Subcommittee and the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. Move to strike the last word. And this legislation is very simple, and it's actually a clarification and an improvement on what was included in the Jobs Act. Reg A is a very important exemption under the Securities and Exchange Act. I'm sorry, the Securities Act of 1933. This exemption has been around since 1933, and it's a very important one for small businesses. Now, in the Jobs Act, there was an increase in a creation of Tier 2 offerings under Reg A, and it raised the number from 5 million to 50 million. That was an important updating of the offering amounts. What this bill does is correct an oversight that was in the Jobs Act, and that is to make sure that Tier 1 offerings under Reg A rise from 5 million to 10 million. Now, the SEC has made great strides in writing this regulation. It's on the books. It's done. And what this does is now, with this new playing field, update and enhance this important offering. It, like Reg A, generally exempts preempts state law and preserves state enforcement. These folks, these securities, are being registered with the Securities and Exchange Committee. This is the starting crew, if you will, of capital raising. These are the best and brightest in the country and in the world that are reviewing these documents. And so we want to make sure that the number is enhanced and updated so more folks can actually raise money. In addition to that, it excludes those that participate in this offering from the general shareholder cap if and only if audited financials are done and in compliance with the Securities and Exchange Committee's rules. Finally, it codifies the resale of restricted securities such as stock options so that the resale of those securities can be preserved, and it also clarifies that the law demands that the SEC codify the resale of restricted securities. It's very simple, and this is an update for those that supported Reg A offerings in the Jobs Act and have supported it before. They should be able to support this without too much of a problem. The reason why we're trying to do this, to clarify, is that in 2011, there was only one Reg A offering in all of the United States. In essence, this exemption had withered on the vine because the SEC did not update their regulations and didn't preempt state law so that these securities could be raised. In comparison, in 2011, there were 8,194 Reg D offerings. Reg D has a much higher regulatory burden and cost for raising money, so it's a higher dollar amount folks usually raise under that exemption. We want to make sure that genuine small businesses can use Reg A offerings, and that's really what this goes to the heart of. In the last 16 years, we've had 240 offerings under Reg A and roughly 15,000 in the last 2 years under Reg D. We need to make sure that we enhance this so that small businesses can access capital and so that investors can be preserved by having national markets, not just for the issuances of these securities, but also the exchange of these securities that folks hold. So with that, I ask my colleagues to support the measure and ask for its adoption.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, this bill would raise the maximum size of smaller Regulation A securities from 5 million to 10 million, preempt the state regulators over such securities, and exempt the shareholders of such securities from triggering the public reporting for the company. In addition, this bill would also create a new transaction exemption to allow purchasers of restricted securities to immediately sell their securities to accredited investors and use general solicitation to do so. Now, I find it alarming that my Republican counterparts seem to think that undermining our state's efforts to protect investors will somehow help small businesses raise funds. Who do you think answered the phone calls from prospective investors about the authenticity of solicitations for investments? If the state regulators have to tell investors that they have no idea if the small business soliciting funds has even taken a modest step of filing a form expressing intent to raise funds, how do you think investors will react? If investors later think they were harmed, do we really want to hamstring the cops on the beat from doing their job by limiting their ability to know the market? I think the SEC inappropriately exempted the state regulators for the large Reg A offerings even after Congress explicitly voted against such preemption. This bill would go a step further and preempt the states from the smaller offerings that have even fewer disclosures for investors. Also, there's a Republican witness, Brian Miller, a founder of Fundrise, who is one of the few individuals with experience raising funds under Regulation A, suggested that the states, not the SEC, should have a primary role regulating these securities. The state regulators have also completed a streamlined filing process that allows small businesses to file in one location and receive approval in as little as 3 weeks, as compared to the average time frame of 100 days before the SEC. Separately, this bill would also create a new exemption for purchasers of private securities to immediately resell those securities to accredited investors. The Consumer Federation of America noted that by undermining regulatory oversight of this market, the legislation would increase the risk of fraud. While this is not necessarily new, the bill would permit general solicitation. Investor advocates suggest that this will further increase the risk of fraud in a market that is already a major source of state enforcement actions. Bill Beatty, incoming president of North American Securities Administrators Association, or NASA, and the Washington state regulator explained that, I quote, while NASA is sensitive to the desire for increased liquidity for holders of unlisted securities, we believe that investor protection may be significantly compromised by this proposal, quote unquote. Such transactions also do nothing to promote capital formation. Investor advocates have also raised concerns that the requirement for sellers to verify the status of the purchaser poses particular challenges and is unlikely to be effectively enforced. Indeed, the CFA writes, quote, because the sales will be conducted by individuals who are not subject to regulation, there would be no way to provide effective regulatory oversight to prevent fraud and abuse, quote unquote. Unless the sponsor of this bill removes the general solicitation language in Section 5 and permits states to have a primary role regulating all Reg A securities, I would have to urge a no vote on the bill. And I yield back the balance of my time.
The lady yields back, seeks recognition. For what purpose, gentlemen, for Virginia seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I would also encourage this committee to support this legislation that Mr. McHenry has put forward. I, too, was very interested in what Ben Miller from Fundrise said in our subcommittee hearing. The ranking member made reference to that. He testified as a local real estate developer, somebody who has sought to use crowdfunding to be able to raise money to be able to make these developments. He indicated that his experience prior to the passage, again, the Bipartisan Jobs Act that was passed, and tried to update some of the provisions to the Reg A exemption. He indicated he wanted to raise $350,000 to pursue a development, and indicated that it took 6 months to go through the process It was hundreds of pounds of SEC paperwork. Went through 8 attorneys, had 8 attorneys, and it cost about $50,000. Remember, this is for a $350,000 raise of capital and 2 sets of financial statements. And he indicated that anything that we can do here in Congress to make it easier for him to, and folks in his position to be able to access this capital. It's good for 2 things. Number one, it creates jobs. Once again, something that the Jobs Act, in a most bipartisan way, supported, and certainly we should continue to look for ways to improve upon that. And that's what Mr. McHenry's bill, it seems to me, does. And then the second thing that he talked about in his testimony was the fact that it helps in a way that protects investors. It helps to democratize investment, and I think that is a worthy objective, as long as we are keeping an eye on investor protection. And I think in this case it strikes the right balance. So I would urge my colleagues to support this measure. I thank the gentleman from North Carolina for bringing it to us.
Will the gentleman yield?
I yield.
I appreciate my colleague yielding, and thank you for your support. I would just say to the ranking member that it's important that with the resale of securities, you have liquidity, because liquidity actually is one of the key investor protection pieces here, the ability to sell a security in a timely way. But the most important thing to contemplate with this bill is it helps small businesses and entrepreneurs get capital so they can start, so they can grow. What we're doing by not updating these regs, which, by the way, I mean, a far more revolutionary approach was voted for in the Jobs Act. This is a small change, and the small change will help the small businesses do big things, and that is really the key thing. There may be quotes from outside special interest groups in opposition to this, but you're not quoting the entrepreneur. You're not quoting the entrepreneur who is trying to utilize this very important opportunity to raise capital. We need to think about the entrepreneur who's being cut off from capital, starved from capital, and that's what this bill is all about, is making sure that they have the opportunity to raise those funds so they can actually have a business or grow a business. And maybe they're just a small business, but one day they could be a big business. But even that small business is a big thing to families and to communities around this country. And that's why I'm offering this, and that's why I ask my colleagues to vote for it. And I yield back.
I yield back.
Gentleman yields back. Who seeks recognition? For what purposes, gentleman from Massachusetts seek recognition?
Move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I feel like the skunk at the lawn party. I'm looking for something I could agree with you folks on, but this is not one of them. Look, the gentleman from North Carolina describes this as a technical amendment. I assume he's referring to that as we refer to a technical knockout in boxing, because this legislation would basically undo the compromise we worked out in the Jobs Act. We did have a recent update on these regs through the Jobs Act. That was pretty recent. Now we're trying to open the door wider. But the key here is that we recognize that a lot of these offerings are local offerings, smaller offerings, as the gentleman described, and in recognizing these types of offerings, we left the states in place to regulate this, because they are small and they robustly preserve, I think, protections for local investors. Now, this bill, this Startup Capital Modernization Act, takes away that state regulation that I talked about before. So we're eliminating them, the state police, so to speak, in the financial sense, eliminating them from this area of regulation. This legislation would eliminate the ability of states to provide oversight. It fails to acknowledge the remarkable progress that states have made in adopting a coordinated review system for Regulation A offerings. And I think we're creating a real danger of fraud and abuse in the sales of these securities from investor to investor under this provision. Those type of sales will do nothing to promote capital formation, and moreover, the requirements that sellers verify the accredited investor status of those other purchases, that poses a particular challenge, I think, in this context and is unlikely to be effectively enforced, because you're asking one group of investors, not sophisticated, to investigate the status of other investors on an arm's length sort of transaction. As the gentleman described, you could have a company trying to raise as small as $350,000. You have to scratch your head why with interest rates very, very low, I could see why people don't look to this area to raise capital as opposed to going to a bank. Rates have been very, very low.
Will the gentleman yield?
I will yield, yeah.
In 2011, there was one offering through this. And if you look at the period from 05 to now, there were 7 on average, 7 per year. In the previous 15 years to that, from 95, well, actually, previous 10 years, from 05 back to 95, there were 23 offerings per year. It's a very lightly used regulation. I'd be happy to work with the gentleman on perfecting.
I just think that, and I reclaim my time, I just think there are a lot of great alternatives to this. This is somewhat more cumbersome, admittedly. Well, but I think that disclosure, because it is more a local transaction in most of these cases, you still need that state oversight, and you've done away with that. So, that causes me.
If the gentleman will yield, they disclose with the Securities and Exchange Commission all their documents. Is that not sufficient?
It is the case, but with the SEC, I think this is probably their lowest priority, because they've got, as you know, they've got a little bit more on their plate these days. And so, but for a state regulator, it would be a significant interest. And so they're more motivated to police these type of transactions than the SEC would be. And that's why I think you leave them. What's the problem with leaving them on the playing field? Let them be the regulator in this case. They're protecting local interests, and these are local interests by and large that are being affected here. We already exempted people if they're operating on a national exchange or at a national level. We've already exempted those because we know they play at a larger level. This is the more local investment that we're talking about. So, and I'm happy to discuss the gentleman about ways we might do what he wants to do, but also preserve investor protections. Thank you, and I yield back.
The time of the gentleman has expired. Who seeks recognition? The chair is going to recognize himself for what will prove to be less than 5 minutes. Just to say, again, I appreciate the gentleman's concerns and concerns articulated by members concerning the issues of fraud. But again, I want to emphasize that the anti-fraud and civil liability provisions of our federal security laws apply to the offer and sale of all securities that are relied upon under Reg A. That includes Section 12A2 and 17 of the Securities Act, Section 10B of the Exchange Act, and Exchange Act Rule 10B5. These protections are already in place. As the gentleman from North Carolina has stated, an incredibly small part of our capital formation market today. I would be hopeful that at the margins we could grow this somewhat. Again, in striking this balance, I think today is the day to err a little bit on the side of actual capital formation, particularly again since all of our anti-fraud and civil liability provisions of our federal security laws remain in place. I don't grow tired of it because it's my job looking at what my constituents have to say to me. Recently, I heard from a gentleman in Mineola, Texas, named Bobby, who said, quote, part-time underpaid work with cost of living so high is destroying families that I know, unquote. My guess is this is a voice that could be heard in any district, any congressional district in America. That's the voice we should be paying attention to in this debate, and particularly where our anti-fraud provisions remain intact. Why don't we err on the side of those who have part-time underpaid work? And so I would encourage an aye vote on the gentleman's bill. Yield back the balance of my time. Who seeks recognition? Are there any amendments? Without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. Absolutely no one is raising their hands. Okay. A sufficient number having raised their hands. A recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Before proceeding, I wish to make an announcement to the members that are present. We'll communicate to all member offices. As I think members know, it is our tradition to attempt to schedule the actual time of votes in consultation between the majority and minority. It is our tradition to typically have recorded votes voted upon the morning after the markup. I think members know tomorrow we have a full committee hearing with Secretary Liu. And now we have had some scheduling challenges on both sides of the aisle for Friday morning. And so in consultation with the ranking member, we do not anticipate votes Friday. Instead, without objection, all our postponed recorded votes will be taken after this upcoming district work period at a time that we will work with the ranking member on. So ordered. Pursuant to notice, I now call up H.R. 3211 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 3211, to amend the Truth in Lending Act to improve upon the definitions provided for points and fees.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Michigan, Mr. Huizinga, the sponsor of the legislation, for 5 minutes.
Thank you, Chairman Hensterling, and appreciate ranking members, Member Waters as well, as we debate and consider H.R. 3211, Mortgage Choice Act. As someone who's worked in the housing industry and construction with my family for a number of generations now, this is an important issue to me and more importantly to our constituents. Earlier this year, the Qualified Mortgage QM ability to repay rule, as mandated by Dodd-Frank, went into effect. The QM rule is primarily means for mortgage lenders to satisfy their ability to pay requirements. Additionally, Dodd-Frank provides that a QM may not have points and fees in excess of 3% of the loan total amount. As currently defined, points and fees include, go through kind of a list here, I'm sorry, Mr. Chairman, but I think these are important to enumerate. Among other charges, one, fees paid to affiliated title companies. Now, that does not count, though, to unaffiliated title companies. Two, salaries paid to loan originators. Three, amounts of insurance and taxes held in escrow. Four, loan level price adjustments. And number five, payments by lenders to correspondent banks, credit unions, and mortgage brokers in wholesale transactions. As a result of this problematic definition, many affiliated loans, particularly particularly those made to low and moderate income borrowers, would not qualify as qualified mortgages, QMs, and would be unlikely to be made or would be only available at higher rates due to heightened liability risks. Consumers would lose the ability to take advantage of the convenience and market efficiencies ordered by one-stop shopping. And I can tell you that for me in my district, the 2nd District back in Michigan, I'm home to the highest Hispanic population in the state of Michigan of any of the congressional districts. We have a large African American population, and one of the 10 poorest counties in the nation, Lake County, resides in my district as well. And I'm very concerned about the ability for access for everyone who is looking to grab a piece of the American dream. So with that, I, along with Representative Gregory Meeks, introduced H.R. 3211, a strong bipartisan bill that modifies and clarifies the way points and fees are calculated. This legislation is narrowly focused to promote access to affordable mortgage credit without overturning the important consumer protections and sound underwriting practices required under Dodd-Frank's ability to repay provisions. Specifically, H.R. 3211 would provide equal treatment for affiliated title fees and clarify the treatment of insurance held in escrow. These common sense changes will promote access to affordable mortgage credit for low and moderate income families and first-time home buyers by ensuring that safer, properly underwritten mortgages pass the QM test. And I'd like to thank my colleague, Mr. Meeks, along with the many others who have worked tirelessly to help fix this flawed provision currently being implemented. And Mr. Chairman, I urge swift consideration and passage of H.R. 3211, the Mortgage Choice Act, to help ensure that consumers have that greater access to mortgage credit and more choices in their credit providers. I'd like to also request unanimous consent to enter in letters of support from the following: American Bankers Association, Community Mortgage Lenders Association, Consumer Mortgage Coalition, Credit Union National Association, Leading Builders of America, National Association of Federal Credit Unions, National Association of Home Builders, Mortgage Bankers Association, Real Estate Services Providers Council, the Mortgage Bankers Association, National Association of Realtors, and the Realty Alliance. So,
without objection.
And with that, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Minnesota seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Let me thank the chairman and ranking member for having this markup today. I'd just like to say that we had a hearing on this matter, related matters, and I was able to ask a few questions at the hearing that made me want to offer a few amendments, which I intend to offer later today. I continue to be concerned by complaints from consumer advocates and independent land title agents about the hidden commissions and fees that raise the price of title insurance for buyers. We know how hard it is to get people into homes. They need to save thousands of dollars for a down payment. But then many people report being overcharged, sometimes thousands of dollars, on title insurance. Why would we want to preserve this practice of overpriced title insurance due to referral commissions? Why would any home buyer want to pay thousands more than they need to or should? At the hearing, I requested that we hear from independent land title agents as well as consumer groups like the Consumer Federation of America, and unfortunately, those voices were not invited to testify at a subsequent hearing. So I believe that H.R. 3211, the Mortgage Choice Act of 2013, may make it easier to raise costs for consumers. I'm concerned about that. The title insurance market is not transparent, it's not competitive, and as a result, borrowers have very little choice but to overpay. In fact, in 2007, the GAO report concluded that borrowers, quote, have little or no influence over the price of title insurance but have little choice but to purchase it, unquote. The QM rules do not solve the problem in the current market, but they help encourage more competitive pricing. By preventing any form of title insurance market, H.R. 3211 would eliminate one effective way to drive down costs for borrowers. More than 100 consumer groups led by the Americans for Financial Reform oppose the bill, and I asked to include their letter of opposition into the record.
Without objection.
So with that, Mr. Chair, I yield back.
Will the gentleman yield?
I've already yielded back. Sorry.
The gentleman yields back. Who seeks Recognition. For what purpose does the gentlelady from West Virginia seek recognition?
Well,
Wow.
I was going to
to
move
fix
to strike
our
the last word, but I might
HVAC
want to vacate.
Well, that doesn't occur every day in a markup.
Okay, I just very
Having
quickly-
said that, the gentlelady is recognized, and I hope she's not harmed by whatever's happening behind that.
I'll watch for the debris. I want to thank the chairman, and I want to thank Mr. Huizenga, who has worked on this bill for several months with across both sides of the aisle, and he's identified a real problem here. And so I think that the consensus that he has reached is to be applauded and approved. I think the ability of a consumer to have choice is something that we're talking about here. And I think, unfortunately, the CFPB's rules make it difficult for those small dollar borrowers to access mortgage credit. You know, I think this is aimed at the first-time home buyer, the low and moderate income home buyer, where prohibitive costs or not being able to get the mortgage over the finish line has been an issue. So with that, I would just urge adoption of the bill.
And would the gentleman
I'd yield the remainder of my time to the sponsor of the bill.
Thank you. And before the building tumbles down upon us, apparently, I did want to just point out to my colleague, who was very quick in yielding back his time, that every state, all 50 states, regulate title insurance. This is not a federal oversight. This is not a bailiwick that we have anything to do with. And I'm confused as to how forcing people to separate where they're doing their shopping for a good and a commodity and a service is going to drive down costs. In fact, that sort of flies into the face of what most economists and, frankly, what virtually every consumer knows, that you know, if I can consolidate my place to go to get done what I need to get done, I might actually save money on doing that, because there's an incentive to the person providing it, as well as an incentive to those that are purchasing it. So to say that there's hidden fees and that somehow the federal government is going to fix this, as I seem to recall, just in the last bill, there was a very much a willingness to let the state regulators go at a particular issue that my colleague, Mr. McHenry, was dealing with. Why in the world are we not, where it already currently lies, letting those states do their job and have them work out what that pricing system is within the state? And with that, Mr. Chairman, I yield back.
Gentleman yields back. Who seeks recognition? The self-proclaimed skunk at the garden party. Gentleman from Massachusetts moved to strike the last word. His phrasing, not mine.
Very briefly.
Gentleman's recognized for 5 minutes.
I would like unanimous consent, please, to offer into the record a letter from the American Federation of Labor and Congress of Industrial Organizations, and 2 letters from the Americans for Financial Reform on sundry bills that are before us today.
Without objection. Gentleman yields back.
Thank you.
Chair recognizes himself very briefly just to thank the gentleman from Michigan. He's been a long-time leader on this issue of points and fees. We know that particularly this can impact low-income home ownership opportunities. Again, a modest but important change, and one that when I look at the number of co-sponsors, has received incredible bipartisan support. I urge its quick adoption, and again, thank him and the Democratic co-sponsors of the bill. The chair yields back. Are there any? The gentleman has already been recognized. For what purpose does the gentleman? Okay, I guess the chair misunderstood. I thought you were, okay. So the gentleman is seeking recognition for an amendment. We'll pause a moment and have the amendment distributed.
we'll consider the
Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment offered by Mr. Ellison, page 2, strike line 10 through 25. Page 3, strike line 4 through 12. Page 3, after line 18, insert the following.
Without objection, the amendment is considered read. For what purpose does the gentleman from Michigan seek recognition?
Yeah, Mr. Chairman, I reserve a point of order.
Point of order is reserved. The gentleman from Minnesota is recognized for 5 minutes to explain his amendment.
Thank you, Mr. Chairman. Mr. Chairman, I offer this amendment in order to lower costs for home buyers. At the hearing that we had on this matter, I asked about any financial benefit that mortgage brokers received. The witness from Quicken Loans, speaking for the mortgage bankers of an Orion Federal Credit Union on behalf of the National Association of Federal Credit Unions, both responded in the hearing and to subsequent questions I submitted for the record that they received no financial benefit from their affiliation. Now, if that's true, my amendment makes a lot of sense and I urge adoption. Just to repeat, Quicken Loans on behalf of the Mortgage Bankers Association says that the affiliation is only for efficiency, that there is no financial benefit. I enter the response to my questions from Quicken Loans into the record, which I'll without objection. So, thus today I offer an amendment that would modify the Real Estate Settlement Procedures Act. My amendment states that the referral agents cannot get any financial benefit from a referral to a specific title firm. My amendment eliminates the exception to the anti-kickback provisions for affiliated business arrangements. Since the witness, who were experts in this bill, denied receiving any financial benefit, then I cannot see why anyone might oppose this particular amendment, and I cannot see why anyone they represent would oppose a prohibition on any fee for referrals to customers. And I urge support of the amendment.
Gentleman yield back.
I yield back.
Gentleman yield back. Who seeks recognition? Is the gentleman from Michigan seeking recognition? Gentleman,
I do move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you. And actually, I'd like to yield to my friend and co-sponsor, Mr. Meeks, on this briefly, and then like to add a note of myself as well. So, I yield.
Thank you. I want to thank my friend Bill Hunzinger for working in a bipartisan spirit to get this compromise bill done. You know, it's been about 6 months now since we have been trying to resolve some of the legitimate concerns that have been brought to our attention on the QM rules. And this bill addresses 2 of those issues by 1, providing equal treatment for affiliated title fees, and 2, clarifying the treatment of insurance held in escrow. Let me also state that is without question, I strongly support the way that the CFPB has proposed, adopted, and adjusted the QM rules. The agency has shown good leadership in taking up a very delicate and sensitive issue to come up with a rule that will provide much-needed protection to millions of Americans. Furthermore, the agency has worked in a constructive and very collaborative manner to provide some exceptions for small lenders and nonprofit organizations. Now, I'm confident overall that The CFPB and the QM rules are starting to provide strong consumer financial protections to millions of Americans, and look forward to continuing to work in a bipartisan manner on this issue. And I think my good friend, Mr. Heisinger, has worked diligently to try to get this done. And I yield back to him.
Thank you. I appreciate my friend looking at that. And I think, as my colleague from Minnesota is what he's attempting to do, is not without merit. As I'm understanding, though, my bill deals with and amends only the TILA element of the federal law in respect to the calculation of points and fees. His amendment is not about how points and fees are calculated. The amendment is dealing with RESPA and a separate federal statute, and it actually is dealing with a different part of how that is not being calculated, but it's a different prohibition. So I guess, Mr. Chairman, my view of it, and from the advice that we're looking at, I'm not sure that the issue or the amendment as offered is actually relevant and pertinent and germane to the bill that we have before us, not saying that the issue is not without merit for further discussion. It's just going to have to be dealt with in a different manner.
So does the gentleman insist on his point of order?
Yes, I do.
Does anybody wish to be heard on the point of order?
Mr.
Not,
Chairman,
in the opinion of
with
the
that, I
chair,
yield back.
Mr. Chairman, I'm sorry. If I could, may I just respond? If I could just draw.
If the gentleman
if I could draw,
the gentleman is seeking recognition on the point of order.
On the point of order, sir.
The gentleman's recognized.
So, Mr. Chairman, and my colleague from Michigan, if I could just draw your attention to the second page of your bill, and I think it would be line 14. The Real Estate Settlement Procedures Act is specifically referenced. And so I think that to argue that this is only about TILA, therefore it's not germane, is incorrect. I mean, your bill specifically identifies the bill that I'm trying to amend.
If the gentleman will yield. We don't amend RESPA, though. That is not what we're doing. It's referenced, but it is not being amended. So that's as I'm understanding it, as we're going through this, that's your problem with the bill. So I yield back.
Does any other member wish to be heard on the point of order? If not, the chair is prepared to rule. In the opinion of the chair, the amendment is not germane. Pursuant to Clause 7 of Rule 16 of the House, the point of order is sustained. Who seeks recognition? For what purpose does the gentleman from Minnesota seek recognition?
Mr. Chairman, I have an amendment at the desk.
I will pause for a moment and allow the amendment to be distributed.
Where are we at? Okay, where are we at?
These are all RESPA
changes. So.
The clerk will report the amendment.
Amendment offered by Mr. Ellison. Page 2, strike lines 10 through 25. Page 3, strike lines 4 through 12.
Without objection, the amendment is considered read. For what purpose does the gentleman from Michigan seek recognition?
Mr. Chairman, I appreciate my colleagues' exercise in giving us all an education in the procedures of committee, but I do reserve a point of order.
Point of order is reserved. The gentleman from Minnesota is now recognized for 5 minutes to explain his amendment.
Thank you, Mr. Chairman and Ranking Member. Mr. Chairman, at the hearing that I've been referring to, again, Quicken Loans was praised for having high ratings from J.D. Power and Associates. That's good. And yet, in subsequent conversations, my staff was told that those ratings are based on consumer satisfaction 30 days after a transaction. In mortgages, 30 days is not adequate. In fact, in title insurance, there was only a statute of limitations of 1 year, which is also not adequate. My amendment amends RESPA to extend the statute of limitations for private transactions from 1 to 3 years. It's my understanding that 3 years is consistent with other federal similar statutes, and the amendment expands home buyer protections. So I urge support.
Does the gentleman yield back? The gentleman yields back. Does the gentleman from Michigan insist on his point of order?
Yes, Mr. Chairman, I do.
The gentleman is recognized for 5 minutes.
Well, again, first of all, I'd like to just say I wish we had heard about these amendments prior to sitting here right now. It would have been helpful. This is a bipartisan bill. We've got folks on both sides that could have been approached. I understand the concern, and again, I guess I won't say we shouldn't have these conversations, but Mr. Chairman, I'm concerned that, again, we're dealing with RESPA here and the creation of federal cases of action fall primarily in the jurisdiction of the Judiciary Committee, not within the Financial Services Committee on this. And with that, I guess that would be my purposes for reserving my point of order.
May I respond, Mr.
Does the gentleman from Minnesota wish to be heard on the point of order?
Yes, on the point of order.
The gentleman is recognized.
I'll simply restate, Mr. Chairman, that the gentleman's bill specifically identifies RESPA and refers to that bill. I believe that makes it germane. It affects the overall theme and the relevance of this issue. So I think if RESPA was not mentioned in the gentleman's bill, we may be in a different place. But when you begin to refer a bill and rely on it in the text of your legislation, I think you open up that legislation for amendment. I think that's the proper test of germaneness here, and I think this is a germane bill, and I urge the chair to rule that it is germane.
Are there any other members who wish to be heard on the point of order? If not, the chair is prepared to rule. In the opinion of the chair, the amendment is not germane. Pursuant to Clause 7 of Rule 16 of the House, the point of order is sustained. Who seeks recognition? There being no further amendments, without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. The bill is ordered reported favorably to the House pursuant to notice. I'm sorry. Without objection, staff is authorized to make technical and conforming changes to the bill. Members will have 2 days to submit views. Pursuant to notice, I now call up H.R. 1779 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 1779, to amend the Truth in Lending Act to modify the definitions of a mortgage or...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Tennessee, Mr. Fincher, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. I move to strike last word.
Gentleman is recognized for 5 minutes.
I'd like to thank Chairman Hensarling for bringing this piece of legislation before the committee today and for working with me to ensure Americans across the country will have access to affordable housing. I really, the chairman has gone an extra mile to work with some members like me that have been frustrated at times, and I really do appreciate that. I'd also like to thank the ranking member, Ms. Waters, for the attention she has shown this issue as well. H.R. 1779, the Preserving Access to Manufactured Housing Act, would make minor adjustments to rules implemented by CFPB in January to reopen access to loans for affordable rural housing. The bill simply clarifies the definition of loan originator so manufactured home retailers are able to provide technical assistance to consumers during the home buying process. It also adjusts points and fees triggers for HOPA loans so access to credit is not cut off to low and moderate income borrowers. H.R. 1779 is about ensuring access to affordable housing, especially in rural America where rental properties are not as abundant as in urban areas. In rural areas, manufactured housing is often the only option for affordable housing. With 112 co-sponsors from both sides of the aisle, this legislation is an example of how we can work together in a bipartisan way to solve problems affecting our constituents. I'd also like to thank Ranking Member Waters, Mr. Pierce, Mr. Bacchus, Mr. Meeks, Mr. Clay, Mr. Ellison, Ms. Sewell, Mr. Royce, and Ms. Beatty for all taking an interest in this issue and raising it with CFPB Director Cordray during a hearing on January 28th. For more than a year, the manufactured housing industry has worked with the CFPB and consumer groups in a good faith effort to provide data and educate them on the uniqueness of manufactured housing market. I, along with Senator Sherrod Brown, have been engaged in many of their conversations as well, and I have personally talked to Director Cordray about the problems we face in Tennessee. Our nation has put forth a lot of effort to help more Americans own a home, but the latest rules affecting the manufactured home industry are moving us backward instead of forward. Since the CFPB's new rules for HOPA went into effect in January, manufactured home lenders have stopped making home loans that are less than $20,000. A $20,000 loan allows many families the opportunity to buy a starter home, enabling them to build equity and gain home ownership or sell a home and move to something better. But the CFPB's HOPA rules may leave many of these families stuck without the ability to purchase or sell a manufactured home. Since the CFPB's rule on the loan originator definition has gone into effect, retailers have been forced to stop providing technical assistance to consumers during the home buying process. Instead of retailers telling a consumer which lenders will be able to make them a loan, consumers blindly send out credit applications to every available lender, resulting in multiple denials, which unnecessarily lower the consumer's credit score. Simply put, the CFPB's new rules have caused a reduction of credit to low and moderate income borrowers with low credit scores. The time to act is now, and I urge my colleagues on both sides of the aisle to join me in supporting affordable housing for rural America. And Mr. Chairman, again, I appreciate your willingness to work with us to move this piece of legislation forward. This is a common sense approach that all of us can support, that help all of our districts all over the country. And with that, I yield back.
I'd like to now recognize the ranking member.
Thank you. I move to strike the last word.
Gentlewoman is recognized.
Mr. Chairman and members, this particular bill, H.R. 1779 on manufactured housing, is a bill that I have a lot of questions about. There's a lot of information that I still think needs to be shared, and I'm going to watch what happens as the CFPB continues to monitor the market and accept data from manufactured housing retailers. But I'm going to support the bill. And I'm supporting the bill because I have been embracing opportunities to support rural communities. As you know, we had a bill on suspension that dealt with what was known as balloon payments. And I learned in dealing with that bill that in rural communities and the way that loans are made and the needs that people have, it was quite necessary to do balloon payments. I had only known about balloon payments in some of the urban areas years ago where it put people at great risk because they were not able to pay that balloon payment when the devil came due. But this was quite different, and I learned a lot about the needs of the rural community. In the same vein, I'm going to support this bill even though I have some questions about it, because again, I want my legislators here, my friends, my colleagues rather, who are from rural areas that are trying hard to make sure that they provide opportunities and they realize the problems of their constituents. I want them to know that we can work together on rural and urban problems without always being opposed simply because it's urban or simply because it's rural. So I would give the benefit of the doubt. And I would put in abeyance those questions that I have in the interest of trying to do something that I think is extremely important to our legislators from the rural areas who have difficult problems in trying to provide housing and support housing in those areas. And it works differently than in the urban areas. So with that, I would urge support for the bill, and I'll yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
Gentleman's recognized for 5 minutes.
Mr. Chairman, thank you. And I'd like to commend and applaud the gentleman from Tennessee for introducing this important legislation to ensure the affordability of credit for the purposes of acquiring affordable housing and manufactured housing in particular. And I would just note that in my home state of Kentucky, 236,000 families reside in manufactured housing. That's about 12.4% of Kentucky's entire housing stock. And what Mr. Fincher's bill does is correct perhaps an unintended consequence of the Dodd-Frank law, but it revises the triggers by which small-size manufactured home loans are considered high cost under the Home Ownership and Equity Protection Act. And it also clarifies that manufactured home salespersons who are not loan originators by any standard, but it would make sure that they're not deemed loan originators under the CFPB guidelines, provided that they receive no compensation from a creditor, lender, or mortgage broker. Dodd-Frank expands the type of mortgage loans that are subject to the Home Ownership Equity Protection Act, but because more than 60% of all manufactured home loans are on the dwelling only and don't include the purchase of land, this has created a problem. As a result, manufactured home owners will have reduced access to financing because small balance manufactured home loans, and a lot of these are low balance loans, would be basically regulated out of existence. And because of the increased liabilities and stigma associated with making these so-called high-cost mortgages, lenders will simply stop making these loans, eliminating a critical source of financing for manufactured home buyers. And don't take it from me, if you talk to the manufactured home industry folks, they'll tell you the exact same thing. This is going to dry up credit for otherwise credit-worthy people who simply have no other way to finance a home. So again, I would just speak in favor of this. I want to also compliment the ranking member because I appreciate her positive words and feedback on finding ways to help low-income Americans in rural areas find access to responsible and affordable mortgage credit. I appreciated her speaking in support of legislation that I introduced yesterday, the Help Rural Communities Act, in supporting that. Again, trying to make sure that regulators in Washington do not, maybe unintentionally, but do not restrict access to responsible and affordable mortgage credit. And so with that, let me once again thank the gentleman from Tennessee for his leadership in making sure that manufactured homes are available to millions of Americans. I yield back.
Gentleman yields back. For what purpose does the gentlelady from Alabama seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. Special thanks to Ranking Member Waters for her willingness to listen on this issue and for helping those of us who represent rural communities and really trying to give us a platform by which we can help our constituents. So I want to thank her for her graciousness in supporting this legislation. I support H.R. 1779 because It helps to reduce regulatory burdens that impede the ability of consumers to access affordable manufactured housing finance options. I also want to thank Mr. Fincher for his leadership on this matter, and to thank him and his staff for working with my staff on this. Home ownership is often regarded as the essential element in achieving the American dream, and manufactured homes provide an affordable means for individuals and families to achieve this end. For this reason, it is critically important that Americans have access to the full array of options, financing options, in order to purchase a home and to purchase a manufactured home. H.R. 1779 would ensure that manufactured housing remains a viable option for affordable housing, particularly for families in rural, distressed, and underserved areas. The bill really has three objectives. It decreases the likelihood that lenders in this very small niche market that they continue to make these types of loans and make them available to consumers. And secondly, this legislation also clarifies that sellers of manufactured homeowners are not considered loan originators in the original sense. Third, the bill would amend the Truth in Lending Act to revise the definition of high-cost mortgage. High-cost mortgage trigger currently has a chilling effect on the manufactured housing market. The HOPA, the Home Ownership and Equity Protection Act, was enacted to curb abusive practices in refinancing and home equity loans with high interest rates or fees. Loans that exceed HOPA's high cost triggers are subject to special disclosure requirements, as well as subject to enhanced Truth in Lending Act penalties. This bill does not change the HOPA triggers for real estate loans. It only changes the trigger as it relates to purchase money loans, like personal property loans on manufactured housing, which were previously exempt from the regulation. More than 60% of all of the manufactured home loans fall into this category, since they are usually the loans are usually only for the dwelling and not for the purchase of the land. Many of the consumers that use these types of loans already own the land, and so the loan is only for the dwelling or the personal property. This legislation would keep the high cost trigger at 8.5% for loans on manufactured homes between $50,000 and $75,000, and it offers a tiered approach by extending the percentage to 10.5% above prime in the case of transactions between $30,000 and $50,000, and it extends to 2.5% percentage point in transactions in amounts of $30,000 or less. It gives the CFPB the discretion to raise the rate to 14.5 percentage points if they find that the lower rate would restrict access to credit and is a deterrent to consumers and a detriment to consumer protection. So we never really get to the 14.5% above prime unless the CFPB authorizes it. As a result of HOPA's change, of this change in HOPA rules, manufactured homeowners now have reduced access to purchasing a home and getting refinancing. Due to the increased liability and the stigma attached to being a high-cost mortgage, so many lenders are getting out of this business. Industry leaders have already indicated that they will no longer make loans for less than $20,000, which has an adverse effect on this market. This bill, therefore, would preserve access to credit for this type of housing market without reducing consumer protection. These types of loans would still be subject to Truth in Lending, to Dodd-Frank, and to oversight by the CFPB. Manufactured housing serves a very unique market, and roughly 22 million Americans live in manufactured housing. With more than 8.5 million manufactured homes comprising of 6.5% of the nation's housing stock. In Alabama, my home state, more than 300,000 families reside in manufactured housing, which comprises in excess of 14% of Alabama's housing market. In districts like mine, where we face tremendous economic disparity and depressed rental markets, manufactured housing must remain an option. And oftentimes it is the only safe and affordable option available. And I'm happy to support this bill.
Time of the gentlelady has expired. Who seeks recognition. For what purposes, gentleman from California seek recognition? The gentleman is recognized for 5 minutes.
I agree with everything that's been said so far. I'm glad we can move this bill forward. I know that Senator Manchin has a bill that's similar. He has different percentage numbers in his bill. I think I like his better than the gentleman's, and I hope that we move toward those numbers as we go through the process.
Would the gentleman yield?
I will yield.
Well, I appreciate that. And the Senate version is very similar to ours, but hopefully we can move this forward today. I want to thank the gentlelady from Alabama and the ranking member for supporting this, and I think the small victories that we get are few and far between, but they are victories. So with that, I yield back.
I would hope that as we move toward the floor and before we vote on this on the floor, that we move toward not only a bipartisan but a bicameral approach to what the percentages ought to be. And I know that the author and the ranking member and the gentlelady from Alabama will be very involved in that. Also, as a very technical matter, I'll want to make sure that the bill applies to the home. We're not trying to apply this to the land, but it applies to the home even if under state law the home itself is defined as real property, because drawing that line as to whether the home is real property or personal property is, I'm sure there are 50 answers to that, and I know the intent of the bill is to apply to the home and not the land, but just because you bolt the home to the land, it's still a home. So I don't know if anyone else wants me to yield time. Seeing no takers, I yield back to the chair.
Gentleman yields back. For what purposes, gentleman from New Mexico seek recognition?
Thanks, Mr. Chairman. I was going to just...
gentleman moved to strike the last word. Gentleman is recognized for 5 minutes.
Thank you. I was just going to seek time and yield it to the gentlelady from Alabama. She was giving all my points and was doing it far better than I would do, and so I'd give her about 15 or 20 minutes to continue if we could. But I really appreciate your comments. In New Mexico, fully half of the homes in my district are manufactured homes, and so this bill is well designed to try to solve the problems that originated under the Dodd-Frank regulation, and so we just would support the bill and appreciate the gentleman's work on that. Ask him to continue with all great efforts. 25% of the community banks in New Mexico stopped lending on the manufactured homes completely because it's just too complex under the new regulations. So that's too complex for me to figure the math out, but there are people who could analyze exactly how many people that's kicking out of the market. I think the gentlelady from Alabama made those points very well, and would just, again, support the legislation and appreciate it being brought forward. Yield back.
Gentleman yields back. Who seeks, for what purpose does the gentleman from Minnesota seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
I want to join congratulations of the bill authors and supporters, although I do have some concerns about it. I have manufactured housing in my district, quite concerned about my constituents who live there and the concerns that they have that are unique to other home buyers. Also, though I grew up in a city, I have lots and lots of rural family and stay in touch with them. So my heart's in the rural areas as well as the city. So I think that I wouldn't characterize support or opposition to this bill as whether you're a friend or not a friend of the rural community or whether you're a friend or not a friend of manufactured housing. The reality is, if you live in a place where there's a lot of in the rural areas, because of those some of the barriers of being geographically separate or dispersed, you are at a disadvantage from a bargaining standpoint in terms of access to services, and that might mean that some people might charge you more. So I'm concerned about consumer protection as it relates to rural America because they're in a not necessarily an even bargaining position, and that's why I'm a little concerned about the bill. So if any home buyer needs protection, it's people who live in manufactured homes. There's a long, painful history of these homeowners facing a broken and predatory financing system. Thanks to Dodd-Frank Wall Street Reform and Consumer Protection Act, the 17 million people living in manufactured housing now receive consumer protections comparable to those who built on site-built homes. This is a victory for millions who reside in attractive and affordable manufactured homes. Since the passage of the federal standards for manufactured homes, these new homes are safe, energy efficient, and can build equity to the buyer. But this bill, I believe, might chip away at consumer protection. So if H.R. 1779 exempts the sales staff who steer home buyers into financing, those salespeople should ensure that manufactured home buyers are getting the best possible financing. Even if the salesperson does not get a commission, they are still seen as a trusted advisor to the borrower and should be required to act as such. I want buyers of manufactured home loans to benefit from additional protection when they're being offered high-cost mortgages. When a borrower is offered a mortgage at 14.5%, that borrower should know that this is a high-cost mortgage relative to other mortgages. I think that the current requirements for Home Ownership Equity Protection Act protections for any loan made at the rate cap of 6.5% above the average prime offer rate for homes over $50,000 and 8.5% for personal property homes under $50,000 is reasonable. H.R. 1779 allows loans as high as 14.5% above the average prime offer rate. This would let borrowers pay as high as 20% without receiving counseling that they might be able to find a more affordable loan. The bill also allows higher points and fees for loans below the $75,000 limit than is currently the law. I share my colleagues' frustration with the limited financing available for manufactured home buyers. When this bill was considered, I asked the committee to take proactive steps to highlight solutions. I asked us to hold a hearing with experts who have successfully provided wealth-building housing finance options to manufactured borrowers. And as I said then, we should hear from the New Hampshire Community Loan Fund or the Rock USA. These nonprofits provided financing to more than 100 manufactured home communities to buy their own land and to run their own community as a co-op. We should hear from other successful nonprofits like CASA of Oregon, NeighborWorks from Montana, NeighborWorks Great Falls, Next Step, and Reinvestment Partners. The Ford Foundation has done extensive work in this area as well. We should also hear from manufactured home buyers themselves. Let's invite members of the National Manufactured Homeowners Association come in and talk. This association represents these individual buyers. Let's ask them to testify if they think allowing lenders to charge them more is a better approach, or perhaps they would rather support and promote a more affordable options. I would also like to hear from the Consumer Financial Protection Bureau on the empirical data they have on manufactured home buyers. What do they say about the market that currently serves them? What do they think could be done to create a more robust and beneficial market that could serve people who buy manufactured homes? Finally, I think this committee should exercise its authority over the FHFA, the Federal Housing Finance Agency, and I have an amendment to try to get at some of the issues that I'm raising right now. So I yield back.
Gentleman yields back, who seeks recognition. The chair will recognize himself. I will be brief because I'm ready to take yes as an answer from the ranking member. I'm ready to take yes as an answer from, I think, over 100 of our colleagues on a bipartisan basis. I'm particularly ready to say yes to the tens of thousands of my constituents in rural East Texas, the good citizens of places like Malakoff and Murchison and Trinidad, and particularly, given the sponsor of the legislation, the good folks in Tennessee Colony in Anderson County, Texas, say thanks to the gentleman from Tennessee for providing them to strengthen their home ownership opportunities. And I want to thank those on the other side of the aisle who recognize that occasionally, no matter how well-intentioned a regulation may be, there can be unintended consequences that particularly have adverse consequences on hard-working, low and moderate income folks. Frankly, if it wasn't for manufactured housing, a lot of folks in the 5th Congressional District of Texas would have no housing ownership opportunities at all. Again, I think this is a common sense bill, which is one of the reasons I think it has garnered such bipartisan support. Again, I want to thank the ranking member for her support and thank the gentleman from Tennessee who's been a real leader in this effort. The entire time that he has been a member of the House, and it's a great reflection upon him and his district. I yield back the balance of my time. Who seeks recognition? The gentleman from Washington. For what purpose does the gentleman from Washington seek recognition?
I move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chair. I yield my time to the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Heck. I just want to say as I wrap up that, look, if the only way to get financing options for manufactured homeowners is to allow the lenders to and to charge them more, then so be it. But I think that we should at least say, let's get some witnesses up here to testify that that's our only option. There are nonprofits that are doing good work, making manufactured housing work at a reasonable price around the country. I'd like to hear what they have to say on the record. I'd like to see what the CFPB's data is that leads them to the conclusions that they're at. And I have an amendment I'd like to propose when it's the proper time for that, to at least propose that we do that. So I yield back the balance of my time to my colleague, Mr. Heck, and I thank him for the time.
Time belongs to the gentleman from Washington.
I yield back.
Gentleman from Washington yields back. For what purpose does the gentlelady from West Virginia seek recognition?
Thank you, Mr. Chairman. I'd move to strike the last word.
Gentlelady is recognized for 5 minutes.
I just briefly would like to enunciate my support for the bill. I, too, live in a state, West Virginia, that many of our citizens rely on manufactured housing, and it suits their needs very well, and I want to keep that option open of choice and availability for them. I think manufactured housing finance is unique, and therefore the provisions of this bill, I think, are necessary to ensure the continued access to credit. I would also say that this is a very, as we've said previously, bipartisan bill. Many of people on this committee have worked together to try to reach a great compromise, and I congratulate the chief sponsors of the bill. Thank you. I will yield.
I thank the chairwoman for her support, and just a couple of things about what my colleague from Minnesota is talking about, and I appreciate the concern. But we have to be careful when we get to the place that we're saying to the private sector, to the homeowner who is trying to buy a manufactured housing product, and also the lender or the seller, that you are experts in your industry, you all know what you want, but we in Congress or at the CFPB, we know nothing about the industry. We know nothing about what's happening there on the ground, but we know better than you do, so we're going to shut the credit off so you can't buy a home. This is a very common sense approach. It is not rocket science. We have spent months on this issue trying to work out all of the details. Again, I appreciate the ranking member, the gentlelady from Alabama, and many colleagues on both sides of the aisle. But we can go on and on and on, but I just really fear. Think about it. Think about the loan originator part of this. Think about going to, let's say Mr. Ellison has a car dealership, and I want to go buy a new vehicle from Mr. Ellison. And I go in to purchase this vehicle. Well, in my district, in western Tennessee, when you go in to buy a new vehicle, the first thing after you decide what color and what make and what model is how am I going to finance it? But Mr. Ellison can't tell me how I'm going to finance it. Now, what we're trying to do, and I don't for 1 second, to my colleague from Minnesota, think that this was intended when Dodd-Frank was passed. I do not think this was intentional. But we're trying to fix it. We've got support on both sides of the aisle, and I understand it's not perfect, but this will work for the consumer and the industry, and everybody will be happy, hopefully, except maybe Mr. Ellison. And with that, I yield back.
Yield back to the gentlelady. Does the gentlelady yield back?
I'd like to yield the remainder of my time to the gentlelady from Alabama.
I wanted to make sure I put on the record that I have heard everything that the congressman from Minnesota so eloquently provided. None of us want to allow any sort of predatory lending, and that's why the oversight of the CFPB, which still is a part of this legislation, is so critically important. And some of the usury, if you will, 14.5%, only can get there if the CFPB institutes that, seeing that the market is so dry and it's a detriment to access to credit. But they have to make that decision. We, as members of Congress, do not. I also wanted to thank the gentleman from Tennessee for his leadership and know that he will continue to work with us. I think that getting the support of the ranking member was huge, and I hope that you'll work with me so that we can get the two bills, the one in the Senate and one, so we can work together on that. And I'm sure you will do that.
Absolutely.
Time still belongs to the gentlelady from West Virginia.
I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Minnesota seek recognition?
I have an amendment at the desk.
I'm not surprised. We will allow a moment for the amendment to be distributed. Have all members now received a copy of the gentleman's amendment? The clerk will report.
Amendment offered by Mr. Ellison, page 2, strike line 23 and all that.
Without objection, the amendment is considered as read, and the gentleman is recognized for 5 minutes to explain his amendment.
Thank you, Mr. Chairman and ranking member. Now, let me tell you, if my amendment passes, I will vote for this bill. All my amendment calls for is study and data to make sure that our assumption that if we make it possible to charge people in manufactured housing more, that in fact will help there be more manufactured housing available. I think it's an easy proposition to get everybody on board. But my amendment would delay enforcement of these changes until the committee receives 2 reports on the status of manufactured housing. I think we need better data on what options are available to manufactured home buyers. We need to know more about their loan performance. We need to know more about borrower characteristics, credit scores, income, etc. We need to know more about the actual risks they pose, and we need to know more about delinquency rates. Are higher-priced loans more likely to default than more affordable ones? What regional differences in manufactured home financing options exist? My amendment would require the Consumer Financial Products Bureau, Consumer Financial Protection Bureau, to provide empirical data on what they have on manufactured home buyers. The CFPB would need to tell us more about the financing market that currently serves manufactured home owners, as well as their suggestions for creating a more robust and affordable market. Now, the Federal Housing Finance Agency would also be required to report on its duty to serve requirements under the Housing and Economic Recovery Act, and Fannie Mae and Freddie Mac are required under the duty to serve responsibilities to serve the needs of manufactured home buyers. So just last week, the Wall Street Journal had an article on Freddie Mac packaging loans for manufactured home communities. I use manufactured home communities because the term trailer parks is pejorative. Freddie Mac purchased about $1 billion in community loans last year. The FHFA has not enforced this provision up till now. So my amendment would require them both to provide us with the analysis. When it comes to meeting the financing needs of the most vulnerable among us, we should be driven by a philosophy of do no harm. Then we should be guided by what does the evidence show. So my amendment, simple enough, it would delay. It would require that these reports be done by December 31st, 2014, and then we could at least act with a little bit more confidence that what we're doing is actually the right thing to be doing. And we might even learn that what we're doing is not the only thing that can be done to help people in manufactured housing. So, again, as I said before, we should not sort of look at this bill as you're for rural communities or not, you're for manufacturing or not. There are a lot of ways to get at what Mr. Fincher, what Ms. Sewell want to do. I just want to make sure that as we try to help people in manufactured housing, that we also don't abandon their right to have some consumer protection too. So I urge adoption of this amendment.
Would the gentleman yield?
Yep. I'll yield.
Just wanted for a brief moment to congratulate the member for offering an amendment which is germane.
1 out of 3, right?
The gentleman yields back. For what purpose does the gentleman from Tennessee seek recognition?
I move to strike the last word, Mr. Chairman.
The gentleman is recognized for 5 minutes.
I want to speak in opposition to the gentleman's amendment. Again, I appreciate his sincerity and concern about this, but he said do no harm a few minutes ago when he was talking about his amendment. Well, the harm has already been done because of the provision in Dodd-Frank. People can't go borrow money under $20,000 and buy a manufactured housing product, a home. I look back at the meetings that we have had since July 26, 2012. 1, 2, 3, 4, 5, 6, just meetings that I've been part of, and my staff has had, again, thank them and committee staff for all of the meetings that they have had and phone calls. Then I look back at all of the data that has been given to the CFPB, June 18th, August 7th of 2012, December 17th, 2012, May 17, 2013, September 23, 2013, March 6, 2014, March 24, 2014. We have spent months, days, hours trying to give them the data that they need to make the best decision, and they have the information they need. This is ready. Again, usually when you have an issue like this that has so much support, this is not rocket science. Again, this is about people all across the country that are trying to buy homes that they cannot now because a provision in Dodd-Frank that has knocked them out. And again, I understand the concern from the gentleman from Minnesota, but we have to be very, very careful when we start to think that us in Congress, even though the product is great for the consumer and the product is great for the customer, we know more than they do, so we're just going to knock it out. We have to be very, very careful. This was an unintended consequence, I think, but we can fix this today. And I am, again, to the gentlelady from Alabama, willing to work with them and do all that we can to make sure this is a very good piece of legislation when it comes from the Senate and we end up having it hopefully signed by the President. So, again, no more studies. I oppose the amendment. And with that, I yield back, Mr. Chairman.
Gentleman yields back, who seeks recognition. For what purpose does the gentleman from New Mexico seek recognition? Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Listening with respect to the gentleman from Minnesota talk about his amendment, I found some things that maybe I couldn't agree with. For instance, he said we should look to the CFPB for more empirical data. It's the CFPB that used their empirical data to classify a county in my district that has 8.5 people per square mile as non-rural. In other words, it's in the same category as New York County, which has 69,467 people per square mile versus 8.5. Now, you'd hope that the empirical data that is swimming around in the heads of the people of CFPB might actually make it to the surface at some point, but even after meeting with them, they haven't done there. So the gentleman asked for more time. The CFPB has already studied this issue for longer than it takes to build a manufactured house, longer than it takes to buy one, and longer than it takes to beat one into plowshares. I'm sorry, but the people in the Southern District of New Mexico are trying to find people who can lend money for them instead of waiting for another study. Now, if the gentleman would like to come to New Mexico, I would invite him. I've invited Mr. Cordray. I've invited the lady who's in charge of manufactured housing for CFPB. We spent an hour with her in our office requesting that they get some sort of direction on this so that the people in the 2nd District would actually be able to borrow money and move into houses. And again, 50% of the houses in the 2nd District are manufactured housing, and so it's an issue that strikes clearly. Now, one rural banker says that the hardworking people in rural New Mexico are being denied access to credit for purchasing a manufactured home because of CFPB policies. So the idea that we're going to get clarity from an agency that can't get the rules right, can't get the definition of rural versus urban right, and somehow they're going to magically this time get it right on the empirical data of manufactured housing. I'm not holding my breath. Consumer protection is more than just low-interest loans. At sometimes it is allowing people to borrow money for the homes they desire to process and to live in. So with that, I would oppose the amendment and yield back.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. No matter how hard politicians and bureaucrats may try, they simply cannot repeal the law of supply and demand. The law of supply and demand is what it is, and Washington can't change it. But if Washington increases the regulatory cost of financing, access to credit will dry up. That is a fact of life. And there's nothing that a politician or a bureaucrat in Washington can do about that, and you don't need a study to make that determination. We don't need another study in Washington to know what the damage that is being done out in the marketplace actually is. If you want a study has already been completed. According to the American Housing Survey, roughly half of the nation's 8.5 million manufactured homes have a purchase price of less than $30,000. And so far in 2014, key industry leaders have already indicated that because of Dodd-Frank, they are not going to originate loans less than $20,000. So that is all the evidence we need that this is creating a dramatic disruption in the manufactured housing space. And so I would urge my colleagues to oppose the amendment, support the underlying legislation, move on, and let's make sure that people in rural and underserved parts of America have access to affordable housing. I yield back.
Gentleman yields back. Who seeks recognition? Are there for what purpose does the gentleman from California seek recognition? Gentleman is recognized for.
I would just point out the amendment says the bill doesn't go into effect until we get these studies. I'm waiting for studies that we said had to be done by a particular date. If I hadn't served in Congress for a while, I would look at this amendment and say it's only going to delay the bill for a while, really through the end of the year. But waiting for a study, particularly from a bureaucracy that may not want the bill to go into effect, I've been here so long, I look at this as a very long-term delay in the bill. If I had confidence that agencies could get us studies on time, I might vote differently. Anybody else want me to yield? I yield back to the chair.
Anyone else seeking recognition? Are there any amendments to the amendment? Not. The question is agreeing to the amendment. All those in favor say aye. Aye. All those opposed say nay. No. Nay. In the opinion of the chair, the nays appear to have it. The nays have it, and the amendment is not agreed to. Are there any further amendments? If not, without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. 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 Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it.
Mr. Chairman.
In the bill.
Roll call.
Who seeks recognition? Gentleman from Tennessee.
Request roll call vote.
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4521 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4521 to modify exemptions from small creditors and mortgage loan services to require a study of appropriate capital.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Missouri, Mr. Lukemeyer, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. I move to strike the last word.
Gentleman is recognized.
Thank you, Mr. Chairman. One of the most common themes of this committee has been the need to help community banks and credit unions to offer our nation's smallest institutions some sort of relief from a growing state of regulatory burdens. Today we have an opportunity to provide some of that meaningful relief. H.R. 4521, the Community Institution Mortgage Relief Act, will change certain escrow requirements for institutions with less than $10 billion in assets that hold mortgages on the books, and will raise the CFPB small servicer exemption threshold from institutions that service $5,000 mortgages to institutions that service 20,000 mortgages annually. Escrow requirements are costly and burdensome for community banks and credit unions. Many community banks and credit unions lack the resources to create and maintain escrow accounts in-house, and outsourcing the work is, for the most part, cost prohibitive. But this doesn't mean that these institutions shouldn't be in the business of mortgage lending. H.R. 4521 states that an institution under $10 billion in assets should be exempt from escrow requirements for the loans that an institution holds in portfolio. Institutions that hold these loans have every incentive to ensure that taxes and insurance premiums are paid by homeowners. My legislation also increases the small servicer exemption threshold from 5,000 to 20,000 loans. This increase will better delineate small servicers from large servicers and give credit unions and community banks greater flexibility to ensure that more of their customers can stay in their homes. Data has shown that community-serviced mortgages performed better than during the financial crisis. We shouldn't be driving that business away from small servicers. Another theme we've touched on time and time again is that we shouldn't subject community institutions to the same regulatory regime as larger ones. A community bank or credit union that services less than 20,000 mortgages should not be subject to the same regulatory scrutiny as an institution that has $2 trillion servicing portfolio. In both the escrow and smaller service areas, Congress and the CFPB has recognized the need to exempt some institutions. And I would point out the number that we're looking at here is 20,000 total. It's not 20,000 per year. So if you're looking at a 30-year mortgage, you're looking at an institution that probably makes less than 1,000 loans per year, probably in the neighborhood of 700 to 800, which is pretty minimal when you look at the size of most institutions. Again, under current law, CFPB has the ability to exempt institutions serving a rural area from the escrow requirements and already has in place a modest exemption for certain servicing requirements. I appreciate the sentiment and recognize that Congress has supported these exemptions, and I think it is time we re-examine them. Both of these provisions are included in H.R. 1750, my Clear Relief Act. That legislation has more than 150 co-sponsors in the House, including 26 Democrats, several of whom sit on this committee. In total, 27 Financial Services Committee members have co-sponsored the legislation that includes the text we are considering today. The broad bipartisan support for the larger bill should indicate to my colleagues that H.R. 4521 is non-controversial, is important, and deserves their consideration. Mr. Chairman, today we have the opportunity to advance meaningful relief for community banks and credit unions. This legislation has the support of Independent Community Bankers of America, National Association of Federal Credit Unions, the American Bankers Association, and the Credit Union National Association. I thank the co-sponsor of this bill and of the Clear Relief Act for their commitment to eliminating just a few of the burdens facing our community institutions. I ask for the support of my colleagues here today and yield back the balance of my time.
Gentleman yields back. For what purpose does the ranking member seek recognition?
Move to strike the last word.
The gentlelady is recognized for 5 minutes.
Mr. Chairman and members, this change to Dodd-Frank alters the requirement that lenders set up an escrow account for high-cost loans to ensure that borrowers account for the additional costs of property taxes and private mortgage insurance as failure to pay either results in default on the loan and likely foreclosure. Consumers already have the ability to waive the escrow account provided that lenders offer a disclosure of the expected additional costs. The CFPB has also exempted institutions with less than $2 billion in assets, and this bill would expand that to institutions with $10 billion in assets. This bill also expands another exemption, which the CFPB has already issued, redefining a small servicer as having a portfolio of as many as 20,000 loans. The current exemption at 5,000 loans ensures that servicers are smaller operations with close ties to and a deep understanding of the community that they serve. As we have learned during the foreclosure crisis, poor servicing has a huge impact on American families, and reducing servicing standards makes it more likely that consumers end up in default or foreclosure. Mr. Chairman and members, I'm really concerned about this legislation because we have gone through a most difficult time with the subprime meltdown and all of the exotic products that were offered that many people did not understand. As a result of what took place, we had a lot of home foreclosures, unprecedented number of home foreclosures. We should be doing everything that we possibly can to ensure that borrowers are able to stay in their homes. Transparency and disclosure is extremely important, and borrowers should understand these escrow accounts and what's included in them so that they don't get confused, not pay the escrow amounts, and end up defaulting on the loan. In addition to that, we really learned a lot about servicers. We learned so much about services until I'm convinced that we need extended legislation to deal with the problem of services. We learned that services lost the consumers, the customers' information, that people who were trying to get loan modifications could not get help from the services because many of them were not well trained. They didn't know what they were doing. Not only did they lose information, they did not, in many cases, consider all of the income of consumers who were trying to get loan modifications, and they denied them without even understanding that they had income that should have been included in the consideration for the loan modifications. I learned how to do loan modifications despite the fact we are warned not to do them and not to take responsibility. But I got waivers from many of our constituents and worked directly with services, and I was appalled at what I learned about services and what they didn't know, how many of them were not trained, how many of them simply did not take their job seriously. Most people thought of loan services as just those people who, you know, collect the mortgages and collect the late payments, etc. But these services had a lot more responsibility that they should have been assuming and a lot more power to deal with these loan modifications if they only had known their job and their responsibilities and honored it. So I wanted us to protect our homeowners. What we're doing now exposes them in this bill. We don't have to do this. We need to make sure that homeowners understand these escrow accounts and that they're paying them. And if they decide that they want to waive the escrow account, provided the lender offer a disclosure of the expected additional costs, that's okay. So I'm just saying to you, be careful with this. You do not want us to get into situations that caused us to have to apologize for what regulators had not done, for what we had not done, and have to apologize for the fact that so many of our constituents ended up in default because it was really a real shame on this Congress, on our Congresses of the past, that we allowed all of this to happen.
Time of the gentlelady has expired. The chair recognizes himself for 5 minutes. One thing I would hope that we would agree on as the ranking member brings up the specter of the financial crisis is that it was not the cause of community financial institutions. I don't really recall any evidence or frankly hearing debate on this side of the aisle to say that somehow community financial institutions, be they banks or credit unions, were somehow responsible for the financial crisis. The gentleman from Missouri's bill is aimed at relief for these institutions. So that would be the first point I would make. The second point I would make is, how did we find ourselves in the world that Washington regulators and bureaucrats can now force people to escrow funds, whether they want to do it or not, pay higher fees for the privilege they may not want? Why are we circumscribing their economic freedom in the first place? And I suppose if we take it to its logical conclusion, the best way to protect somebody from the responsibilities and privileges of home ownership is to prevent them from having the opportunity to own a home in the first place. I hope and believe that is not the intention of my friends on the other side of the aisle, but taken to its logical conclusion, that is where we are headed. So I want to thank the gentleman from Missouri who has led on this issue and so many other issues in helping ensure that community financial institutions can serve their principally rural and inner city populations. They play an incredibly important and vital role in our nation's economic fabric. Again, this was taken from this particular bill out of the larger CLEAR Act, which I think now has roughly a third of the entire House as co-sponsors, including a lot of members on this committee, almost all on my side of the aisle, and at least several on this side of the aisle as well. So again, I think it is a measured response, but a very important one. Our community financial institutions are disappearing. And if you talk to them, or if at least you talk to the ones in the 5th District of Texas, they will tell you it is the regulatory burden, regardless of what the Federal Reserve or CFPB or someone else may say at that witness table. But the community financial institutions in East Texas and East Dallas, Mesquite, the places I represent, will tell you it's this regulatory burden. And to have, a community banker tell you that, there's somebody I know, I wanted to loan them money, they finally saved up enough for a house, and now under this new regulatory regime, I can't do it. That's not right. It's not fair. So I want to encourage all members to support again what I think is at least currently a strong bipartisan measure that the gentleman from Missouri has worked on for quite some time. And again, I want to thank him for what he is doing for those who are served by community banks. Yield back. Who seeks recognition? For what purpose does the gentleman from South Carolina seek recognition?
Strike last word.
The gentleman is recognized for 5 minutes.
And I won't take the whole 5 minutes, but I'm interested to hear the debate back and forth on this. I'm trying to get my hands around it. It sounds like what Mr. Luchtemeyer's bill would do is simply relieve certain small financial institutions of the obligation to provide escrow accounts. These are the accounts that people use to pay their taxes and pay their homeowners insurance. There are folks who are opposed to that. Under the theory, the only theory I can see of why you'd be opposed to that is if you really think that people are not smart enough to pay their own taxes and to pay their own insurance. And that's stunning to me. Maybe that sort of reveals more about Dodd-Frank than anything that we've done in a long, long time. That you have to have somebody tell you that you have to pay a little bit every month so that you have enough money left at the end of the year to pay your taxes. And you have to force somebody to tell you you have to pay a little bit of money every single month so that you have enough money to pay your homeowners insurance. That's what escrows are. I used to set them up. You pay a little bit of money every month, so at the end of the year, your servicer pays your taxes for you, your servicer pays your homeowner's insurance. If you don't want to do that, or if your bank doesn't want to do it, by the way, I believe this started as a service, as a courtesy that the banks provided to their customers to make sure that folks paid. Wasn't mandatory, wasn't optional, it was a service they offered. But there are folks who would mandate that, and it strikes me that the only reason you would mandate an escrow account is because you think people aren't smart enough to do it on their own. And it just strikes me that maybe there's more of that rooted in Dodd-Frank than anything else. I happen to disagree with that. I think if you're smart enough to buy a house, you're probably smart enough to know you have to pay taxes on the house. Goodness gracious, you should be. If you don't know you're supposed to pay your property taxes, you probably shouldn't be buying a house. If you're smart enough to buy a house, you probably should know you have to pay insurance on that house. If not, you probably shouldn't be buying a house.
Will the gentleman yield?
No, I'm going to yield my time to Mr. Lukemeyer in just a second. I thank that. But it just strikes me that there is a difference of opinion regarding the trust in the individual. And I think that there are more folks on this side of the aisle who believe that if you are mature enough to go out and borrow money to buy a home for you or your family to live in, that there's other things you are capable of doing without the government making you do it under penalty of law. With that, I'll yield the balance of my time to the gentleman from Missouri.
Thank you, Mr. Mulvaney. Just a couple points here. I have to realize that these are not mortgages that are sold. These are mortgages that banks made themselves and are going to hold on their books. Therefore, they have a vested interest in making sure these things are adequately secured and properly managed. By making their own decision on whether to escrow or not escrow, they are judging whether that individual is somebody who can make those insurance payments, those tax payments on their own, and therefore lower the cost of that loan to those individuals. These banks that do this, we already do this for under $5,000. We're all doing is raising the number to 20. And you stop and take notice and think about how many extra loans that is per year. It's pretty minimal when you look at that. The number of 20 sounds large, but when you look at it over a 30-year period, when you're holding a 30-year mortgage, you're really not adding that many more loans per year per bank. And it's not like these banks are not going to be regulated. The examiners are still going to go in, they're still going to look at these things, and if they see some problems with these guys, they're going to go out and make them toe the mark and maybe do something like escrow if there's a whole lot of technical exceptions within their portfolio that says, hey, we are not doing a good job of keeping up on taxes and insurance, things like that. They can request that be done. I think if the bank's going to sell it, the secondary mortgage, then that escrow is a necessary part of that. That's fine. The customer knows that up front. That's disclosed to them. But I think this is just a way to better service the individual customer, whether it's in rural or urban or metropolitan or suburban areas, wherever it is, that community institution that's making that loan knows that customer better than anybody. And the problem in the past was not the community banks making these kind of loans. It was the loan brokers, the mortgage brokers that packaged these things without the proper documentation and some of the appraisal problems that were involved and some of the disclosure problems. That's where some of the problems were. It wasn't the community bankers going out here and packaging a lot of unsecured or poorly managed loans. So I think that what we're talking about here is pretty minimal when you look at it in the scope of how many extra loans per year does this particular institution actually going to make and then hold themselves. They're holding their own portfolio, so therefore they're the ones that are at risk. It's not the investor out here that's holding the security that's securitized by mortgages. It's the bank themselves that hold these loans. So I think that we've got a pretty good piece of legislation here that actually helps, I think, in the long run, consumers, which I think is the bottom line. And I yield back the balance of my time to Mr. Mulvaney, who apparently is ready to yield back the balance of time to the chairman.
Gentleman yields back. His time has indeed expired. Who seeks recognition? Are there any amendments without objection? Previous question in order. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it.
Mr. Chairman? Could we get a recorded vote?
A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I now call up H.R. 4466 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 4466 to require certain financial regulators to determine whether new regulations or orders.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentlelady from West Virginia, Ms. Moore Capito, the chair of the Financial Institutions Subcommittee and the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. Thank you for bringing this bill before the full committee, and hopefully it will pass the full committee. I'd like to thank my friend and the ranking member of the Financial Institutions Subcommittee, Mr. Meeks, for working with me on this legislation. This is sort of a repeating theme that we've seen throughout the last several years is the accumulation effect, the cumulative effect of regulation and what kind of effect that's having on particularly our community bankers. So the issue we're trying to address today is the growing concern about this cumulative effect. We've heard testimony almost every time we have witnesses, the testimony, no matter what the subject matter, the testimony from numerous community bankers and credit unions is they always are talking about the new challenges they face with keeping up with new regulations and how those new regulations interact with old regulations. So we introduced the Financial Regulatory Clarity Act, and basically our approach is that we simply ask each federal regulatory agency to conduct an analysis as part of the rulemaking process on how the proposed rule would interact with the existing regulatory framework. We ask them to identify 4 areas. If the proposed rule is in conflict with the existing regulatory framework, if the proposed rule is inconsistent with the existing regulatory framework, if the proposed rule is duplicative of the existing framework, and then to identify outdated federal regulations. Probably if you're listening to that litany, you're probably thinking that's already occurring, but it really isn't, and that's what we're trying to get here today. So after this analysis is completed, then the agency will take 2 steps. It will reconcile any conflict, inconsistency, or duplications, and then will also generate a report to Congress with recommendations that any laws that could be changed that would reduce these conflicts. In a sense, we are asking the financial regulatory agencies to address conflict, inconsistency, and duplication as they issue these new rules. And I think that it's necessary because we heard from Bill Loving, who is a community banker in my district. He said he's recommended specific regulatory relief measures, but the problem is a cumulative one. We heard from Kenneth Burgess with the American Bankers Association. Quote, unfortunately, the cumulative impact of years of new regulations are combining into a potent mixture that will surely, if left unchecked, lead to more and more consolidations. We also heard from another gentleman from West Virginia who's president of the Bear Heritage Federal Credit Union. He talks about, while everything being well-intentioned, there is often little coordination between regulators and without elimination or removal of outdated or unnecessary regulators. Even the regulators, the FDIC, when they generated their report on the banking study of community banks, they said that while most participants said that no single regulation had significant effect, instead it was, and I quote, the strain on their organization came from the cumulative effects of all the regulatory requirements that have been built up over time. So we've had some discussions on this, trying to work a draft that we could both come to agreement on, and that's what we see in front of us today. And so I would hope that, and I ask this question every time we have a regulator in front of us. I ask the question, what are you doing about duplicative, outdated regulations? And really the answer that I get is just sort of some sort of vague, yes, we look at it, we try to see it, but there's no definitive way that I'm convinced that this is actually occurring. And I think that this bill that we have in front of us today is a very simplified version of saying, get rid of the duplications, the conflicts of the proposed rules and the outdated proposed rules as you're moving forward with new regulation. And with that, I would again like to thank the ranking member. He's worked very hard on this, and I'd like to thank the ranking member Waters as well, because I know she has weighed in as she always does, and we welcome that on this piece of the legislation. And I yield back.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentleman from New York seek recognition?
Strike last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. And I also want to thank Chairwoman Capito for her hard work and working in a bipartisan manner. We've been working on this legislation for almost 4 months now. And throughout this time, we've had hearings and we've had various consultations, including discussions with regulators. And I've been trying to talk and have talked with some of my fellow Democrats to talk about issues that are important in regards to this bill. And I do want to also thank Ranking Member Waters because although I don't think she's with us on this bill, but she has made this a better bill. Her contributions and her thoughtfulness, and I understand her point of view on this, made this a better bill. For example, it was brought up that this bill would allow third parties to stop rules through court challenges, and this was a very big concern that was brought up, and so we made sure we had to add a judicial limitation to the bill. We also heard, from some of my colleagues and Democratic colleagues coming back that the bill was too broad and inclusive of too many regulations. And so Chairwoman Capito and I worked together, and we made sure that we responded by specifying that the agencies would only have to reconcile conflicts they have themselves identified within their own regulatory framework. And we were concerned about the burdensome, that it would be so burdensome. So we tried to put in the bill also that the review would be part of their existing rulemaking process and would not stop the agency's ability to proceed with new laws, so that would not hurt. And then again, we wanted to make sure that the language was not too strict, because some had said, some of my colleagues, it was too strict and would require agencies to take extreme measures. And so we tried to put in the bill again. We provided more flexibility for the agencies by stating that they should use best efforts to reconcile inconsistencies. So we were trying to work to make this a much better bill, and I think that those inclusions have made it a better bill. But I wanted to make sure, and the reason why I think this bill is important is time and again when I met with especially the small, the community banks, the credit unions, and the minority bankers, to be quite honest with you, they all said that it's a problem because of some of these redundant regulations, and they don't know which one to follow, et cetera. It would make it much easier for them because the cost was prohibitive, and they would not be able to give the kinds of loans to potential homeowners and for small businesses. And to me, we're not talking about the Goldman Sachses of the world or the Chases, or the big banks. My focus has been to trying to make sure that the small person, the individual who is looking for the American dream, buying that home. Too many folks after the crises continually come up to me and say that they can't get a loan. And as I talk to some of my own local people, that's what we did on this. We had the hearings, but I wanted to verify by talking to some of my local folks who I know that my constituents, in fact, rely upon to try to get those mortgages or a small business loan, et cetera. And when they repeatedly said that this was a problem for them, I think that I wanted to listen and want to make this bill is important to helping addressing some of those concerns so that we can alleviate some of those issues. And I know, for example, and I think that when we look at it, because some believe that they already have a mandate to do it, and maybe that's so, but I've also learned on occasions there's other things that they had, some agencies have a mandate to do, but after the crises strike, for example, this flood insurance issue that we had and rates went up crazy because they weren't doing what they were supposed to do, that we need to make sure that there's something else that we as Congress can do. And I think this bill gives Congress a more direct role in trying to assure that what should be done is getting done. And if they're doing it already, because some agencies said that they're doing it already. And if they're doing it already, then this bill is not going to be an obstacle to them. This bill is going to be fine because they're doing it already. It won't affect them at all. If they're not doing it, well, this bill will then cause them to do it. And I think that that's the balance that we were trying to strike here. And again, I thank Chairwoman Capito and all of my colleagues for trying to work together to make this a bipartisan bill and a better bill. Thank you. Yield back.
For what purposes, the gentleman from Missouri seek recognition?
Strike last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I certainly support the legislation because I think, again, to try and relieve the burden of duplicative and oppressive rules and regulations that are confusing and inconsistent is certainly something that we should always be supportive of. Agencies should try to work together to minimize that. But to me, one of the key parts of this bill is the section that has a report to Congress. So in other words, once the agency finds that there is a duplication, that there is an inconsistency, there is something that needs to be done, they bring that to the attention of Congress in the form of a report, and the bill states that Congress may then repeal or amend any conflicting, inconsistent, duplicative, or outdated laws and regulations. So we're not empowering the bureaucracy to make arbitrary decisions. We, the Congress, are still in control of this, and so therefore, if we see the recommendation from the agencies that we don't agree with, we don't have to approve it. But they are charged with this bill of bringing to us instances that they see where there's duplication or inconsistency so that we can work together. I think it's a great partnership and it's a great step forward, and I certainly appreciate the hard work of the chairman of the subcommittee that I serve on there. Chairman Capito does a great job of going after these sort of duplicative regulation situations, and I certainly support her legislation. With that, I yield back.
For what purposes, ranking members seek recognition? Ranking members recognized for 5 minutes.
Mr. Speaker and members, let me just say that I recognize that we have members on both sides of the aisle who are concerned about community banks. And we have demonstrated in any number of ways that we wish to make sure that community banks can operate without overdue regulation and burdensome laws that are imposed upon them. I have attempted to work with the chairman of this committee to come up with comprehensive laws to deal with specific areas that our community banks have identified for us, and we continue to ask them for specificity because we're so interested in making sure that community banks are successful. Having said that, this bill goes too far. It is unclear what the statute means by inconsistent or duplicative, making it very challenging for an agency to prove that it has taken so-called best efforts through all available means to reconcile discrepancies, while failing to meet the requirements of this act alone cannot cause a rule to be challenged. If a rule is challenged on other grounds, opponents of the rule may use requirements under this act to prolong litigation and frustrate the rulemaking process. Agencies are already required to streamline rulemakings with previously finalized rules through the Administrative Procedures Act and other processes, including mandatory reviews of all agency regulations. The bill requires regulators to take best efforts through all available means to reconcile their rules, a requirement which removes the agency's discretion and could hamper an agency's ability to balance its safety and soundness versus its consumer protection mandates. Many of the members on this side of the aisle have strongly opposed other bills which subordinate consumer protection regulations. I would simply say that while I give credit to the members on both sides of the aisle for having real concerns about our community banks, not only does this go too far, this frustrates the system in such a way that our regulatory agencies will never be able to do the kind of rulemaking. And we're talking about all of the bank regulators that are included in this bill. And they have to report to Congress for every bill. Nothing will ever get done. This is just too overwhelming. This is too awesome to expect that you will be helping community banks or any other banks with this kind of legislation. You will do more to hurt the consumers because of the widespread reach of this legislation. So I would ask for a no vote on it. With all due respect to the members who are concerned about community banks, this is not the way that we should go about showing that concern. This frustrates the system, period. I yield back the balance of my time.
Gentlelady yields back. The chair recognizes himself for 5 minutes. I listened very carefully to what the ranking member had to say on, I believe she said this bill goes, quote unquote, too far. It is a bill mandating a study, a report to ensure that our community financial institutions that are withering on the vine. We know there have been, I believe, several hundred mergers that have taken place over the last few years. A request for a new bank charter, I think, has now been officially listed on the endangered species list. They are very, very difficult to find anywhere within the country. So I'm trying to figure out exactly what goes too far to assess whether proposed regulations have conflicts or duplication or inconsistent, and tells the regulators to at least evaluate whether or not this is outdated. I understand that the ranking member has concerns about judicial review, that somehow this could be used to slow up the regulatory process as opposed to making it more efficient, more logical, more job-friendly. It is my understanding, and I would yield to the ranking member, but on page 3, line 17 through line 21, I was told that language was inserted at your request because it takes care of the very concern that you just articulated. Now, if I've been misinformed, this is the section that is entitled Limitation of Judicial Review. Notwithstanding any other provision of law, a court may not compel action or hold unlawful and set aside any action solely on the basis of compliance or noncompliance with the requirements of this subsection. Now, again, perhaps I was misinformed, but I thought that language was put in at your request to ameliorate your concern, and I'd be happy to yield to the ranking member on this topic.
Thank you, Mr. Chairman, for yielding to me. We worked in several different ways to try and make this a better bill. Not only did we have advice on this area of judicial review, we had advice, concerns that were articulated on other areas of the bill. So if you're saying that you were told that any advice that we gave that was taken into consideration would cause me to support the bill, then you have been misled.
Well,
that is not the case.
Okay, reclaiming my time, the narrow question is, did the gentlelady request the language on page 3 from lines 17 through 21? That was the specific question. And if not, again, perhaps I was misinformed, but I thought that language was inserted at your request.
Mr. Chairman?
I'd be happy to yield to the gentleman from New York.
That language was submitted at my request. We had consultation. We was working closely, but at no time was there any representation made that the ranking member would take any language that would cause her to support this bill. As I stated in my opening statement, we tried to work very carefully with the ranking member and others to get words to make this a better bill. But at no time did the ranking member ever say to me that if you have this language included, that would mean that I would support it.
I'll reclaim my time simply because I'm running out of time. And again, I did not assert that the ranking member ever said she would support the bill, but I thought in one of the concerns that she raised that it was her language that was included in the bill to ameliorate that specific concern. I understood several concerns that she had, but with respect to the specter of litigation, again, whether she requested it, you requested it, whoever requested it, I read it on the record, and it's pretty, it's fairly plain spoken language, so if it doesn't ameliorate the concern, I think it should, and the chairman's time has expired. Who seeks recognition? Are there any amendments? The general. Okay. For what purpose does the gentlelady from West Virginia seek rec? Gentlelady has a manager's amendment at the desk. We will pause for a moment and allow the amendment to be distributed. Have all members received a copy of the manager's amendment? If so, the clerk will report the amendment.
Amendment offered by Mrs. Capito, page 2, line 6, insert final.
Without objection, the amendment is considered as read. The gentlelady is recognized for 5 minutes to explain her amendment.
Thank you, Mr. Chairman. The effort on the manager's amendment is to address some of the issues that the ranking member brought up, and we have worked very diligently to try to answer her concerns, and I would say that I have never heard that any adjustment made to the bill, and you did not say this, Mr. Chairman, that would garner her support, but we're going to keep trying, okay? I would say that one of the issues that was raised as concern is that a regulator would be responsible for an area of regulation in another regulator's area. In other words, if the CFPB is conflicting with the CFTC or the OCC, then they would have to work those differences out. So we explained it within the bill that you're really only responsible for your own bailiwick, whatever your regulatory area is. And I think that's a logical, piece of clarification. The other things, the ranking member talked about the burden on the regulatory agencies, and so we did try to narrow some of the focuses here to harmonize the definitions, to make sure that the agencies, and working with the agencies to help to clarify for them where this begins and ends for them. And so, but you know, when I heard the ranking member talking about the burden on the regulatory agencies, I get that. But I've got quote after quote after quote after quote of the burden on the community bankers and the credit unions, on the burden on them of trying to figure out what the cumulative effect of all these regulations are. So let's just say you're a community banker in Franklin, West Virginia, small institution, serves a remote area in my state, and does so very well, has worked with families for years. They don't have the capacity. They don't have the ability to really go in and devote the resources to find their own conflicts in the law. So what do you do when you find a conflict in the law and you decide, if I loan to this farmer, I'm going to have these kinds of, that's okay under this regulation, but this new regulation that we're putting forward, and we can even say this, see this in the QM space, this new regulation putting forward, well, I might not quite, it doesn't quite fit that either, so this older regulation, what am I going to do? You're just not going to offer the business. You're going to stop because you can't take the possibility of running afoul of your regulator. And I think most folks, we talked about community bankers and credit unions being very careful about making sure they're following the correct regulations. And I think that this is just an attempt to say to the regulators, help these folks out. And I think part of Dodd-Frank originally was to call out old regulations, outdated regulations, things that were no longer effective. I remember asking Secretary Geithner, give me an example of any regulation that you've tossed aside because Dodd-Frank has taken the place. He really couldn't come up with anything, and this is one of the charges, I think, in Dodd-Frank. So I think we're trying to clarify in the manager's amendment the burden on the regulatory agencies, understanding that they have a lot of challenges as well. And we've worked with them, I think, very diligently. But I do think that we've got to look at the challenges of in our community banking system to see how we're going to be able to move forward with that model and how they're going to meet the challenges of an increasingly complicated, detailed, conflicting, mammoth amount of cumulative regulation. With that, I yield back.
Gentlelady yields back. Who seeks recognition? Are there any amendments to the amendment? If not, the question is agreeing to the amendment. All those in favor say aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is agreed to. Are there any further? A recorded vote has been requested. Those. Okay.
Dispense with this one first.
We're going to dispense with this amendment. Is this an amendment to the? Okay. Okay. In that question, again, the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is agreed to. For what purpose does the gentleman from Colorado seek recognition?
I have an amendment at the desk, Mr. Chairman.
We will pause for a moment and allow the amendment to be distributed.
Must be marijuana.
All right.
Clerk order.
Thank you, Mr. Chairman.
The gentleman's not recognized quite yet. The clerk will report.
Amendment offered by Mr. Perlmutter. Page 18 after line 21, insert the following.
Without objection, the amendment is considered as read. For what purpose does the gentlelady from West Virginia?
I reserve a point of order.
Point of order is reserved. Gentleman from Colorado is recognized for 5 minutes in support of his amendment.
Thank you, Mr. Chairman, and I appreciate the gentlelady from West Virginia posing a point of order. I'm going to offer this amendment and then withdraw it after there has been some discussion and debate. What this amendment is this is a situation where we really do have a conflict in banking laws and in laws dealing with credit unions, and that's between the states and the United States. And this involves marijuana. 21 states plus the District of Columbia now have laws that involve either medical marijuana or marijuana used for all adult purposes, legalized. So Colorado and the state of Washington have legalized it for all adult purposes. The other 19, either District of Columbia or states,
have allowed it for medical purposes. There are 5 states, Alabama, Florida, Kentucky, Pennsylvania, and Utah, which are currently, legislation is underway to allow some level of marijuana use or cannabis oil for medical purposes. And then there are 10 states considering either legislatively or by ballot issue legalizing it for all adult purposes. So this is an issue that we find the states in conflict with the federal government, those states that have chosen to move forward on legalizing at some level the use of marijuana. Because in our banking system, we now find this conflict, and the chairwoman used the word conflict about a half dozen times, and clearly we need to reconcile the conflict that says if banking institutions provide financial services to those businesses that are legal in their state or the District of Columbia, provide financial services, they, however, are in violation of federal banking laws and may have crossed an aiding and abetting or a money laundering situation. But what it does cause, because of this conflict, businesses that are completely legal in their state are forced to deal in cash. They aren't provided with credit cards, payroll accounts, checking accounts, those kinds of things, and everything is done in cash, which leads to its own sort of crime problems. Robbery, assault and battery, tax evasion, skimming, and we've seen the federal government and the regulators, whether it's on the banking side or the credit union side, face this conflict between state laws that have allowed some level of marijuana use and business and the federal law under the Controlled Substances Act. We need to reconcile this. This truly is something that is in the national interest. It is a matter of states' rights, and it is a matter of personal rights, particularly in those states that do allow either for medical marijuana use or use for all adult purposes. This isn't that I'm some big supporter of marijuana use, but I am a supporter of making sure that the states' laws align with federal laws and that we aren't dealing just in buckets full of cash that draw potential for real crime and harm to people. So I would suggest to my chairman of the committee and to the chairwoman of financial institutions, we need to have a hearing on this subject. I see my friend from Missouri. There's issues of this coming up in Missouri. My friend from New Mexico, medical marijuana, but potentially being fully legalized in marijuana. Kentucky just passed something on cannabis, use of cannabis oil. This is not, by the end of this year, more than half the states will have some level of marijuana use, and we just have to deal with it. So I would yield back my time to allow others to debate, and then I will withdraw the amendment.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Washington seek recognition?
Move strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chair. Everybody's instinctive reaction to any proposed legislation or amendment that includes the marijuana word is to be resistant, because that somehow gets translated in our minds as being supportive of consumption of marijuana. And absolutely nothing could be farther from the truth with respect to Mr. Perlmutter's proposed amendment. He suggested to you it was a matter of states' rights and personal rights. He also said, but not use the word, that which I will suggest to you. This is fundamentally, first and foremost, more than anything, a matter of public safety. Here are the two conditions which should lead you to support this amendment. If you agree with the following two statements, you should support this amendment. Number one, you want to keep marijuana out of the hands of children. And number two, you want to keep cash out of the hands of the gangs and the cartels. And they are related. If we compel this market, which is being stood up in Colorado and Washington and the other 19 jurisdictions, to be all cash, and all cash is all bad, we're putting out the welcome mat for organized crime. We will incentivize those to deal in this product who don't care whether the purchaser is a minor or not. They don't care. You care, and I care, that we keep cash out of the hands of the gangs and the cartels, and that we keep marijuana out of the hands of children. Now, just by way of reference, you should all know that on February 14th, Valentine's Day, the Financial Crimes Enforcement Network issued its guidance parallel to the so-called Cole Memorandum from last August in the Department of Justice, which suggested to banks and credit unions, if you meet the following terms and conditions, we will deprioritize pursuing this matter. But there is substantial resistance because the law remains as it is, which is why this amendment is so necessary. If you want to keep marijuana out of the hands of children, and you want to keep cash out of the hands of the gangs and cartels, you want to avoid tax evasion and armed robbery and all manner of illicit activity that is not healthy, then you would support this amendment, or, if I may respectfully suggest, you will at least hold a hearing in subcommittee on this matter so that all the issues can be fully aired, so that we can hear from the Department of Treasury, so that we can hear from the financial institutions who are trying to negotiate and weave their way through this minefield to do the right thing. I'm going to say it one more time. If you want to keep marijuana out of the hands of children, and you want to keep cash out of the hands of the gangs and the cartel, then we must move in this direction. Please do not conclude that this is avoidable in the long term. It is not avoidable. And the sooner we step up, the better we will serve the interest of public safety. You do not have to support consumption of marijuana to know that this is a good idea. Thank you, Mr. Chair, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? Does the gentleman from Colorado wish to seek? Gentleman from Missouri seek recognition?
Strike the last word.
Gentleman's recognized for 5 minutes. Before I recognize the gentleman, though, I do wish to bring to the attention of members that votes are expected at the floor between 2:50 and 3:15. After this amendment is withdrawn, as the gentleman indicated he was going to withdraw it, we have one more bill pending before the committee. If it is the will of the membership to attempt to get this done before floor votes, I simply wish to make that make those facts aware to the members. Now the gentleman from Missouri is recognized.
Thank you, Mr. Chairman. I'll be brief. I understand the concern of the gentleman from Colorado and from Washington. I think we're trying to change federal law by going through banking laws here, which I'm not, with the FDIC regulations, but I'm not sure that's the way to go. But I appreciate your effort. But I think the dilemma that you're facing here and seeing that an industry is choked off for being able to do its business by not being able to have financial services has implications down the road from the standpoint that we, for those of us in one of the committees, we've already discussed Operation Choke Point, where DOJ and the FDIC are trying to choke out non-deposit lenders, as well as FDIC has a list now that we have a copy of other industries that they intend to try and have heightened scrutiny on, which is a wink and nod type way of saying these are also groups that we're going to try and figure out if we can choke them off as well. And I think you can see the effect of not having financial services. It lends itself to all sorts of problems by eliminating services and providing a probable cause for some criminal activities. And I think down the road we're going to have to address a number of issues similar to this with regards to non-deposit lenders and the Operation Choke Point that's going on with our regulators at this point. So I just want to make that point. And I think this is the fruition of choking off financial services, which is something we're going to take a look at down the road. I yield back.
Gentleman yields back. Who seeks recognition? Does the gentleman from Colorado seek recognition for what purpose?
I seek recognition to withdraw the amendment and to advise the chairman that even his state of Texas is considering decriminalizing the use of marijuana. And with that, I would withdraw my amendment.
Not the state of Texas. Are there any further amendments? If not, without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the bill is ordered reported favorably to a recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, a vote on this question is postponed. Pursuant to notice, I now call up H.R. 2673 for purposes of markup and move that it be reported to the House with a favorable recommendation. The clerk will report the bill.
H.R. 2673 to amend the Truth in Lending Act to provide that residential mortgage loans held by portfolio qualified.
Without objection, the bill is considered as read and open to amendment at any point. The chair recognizes the gentleman from Kentucky, Mr. Barr, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. H.R. 2673, the Portfolio Lending and Mortgage Access Act, is a very simple piece of legislation. It is a straightforward one-sentence bill which simply provides that a mortgage loan held in portfolio by the creditor is considered a qualified mortgage for purposes of complying with Section 1411 of the Dodd-Frank Act. This is a common sense bill because it recognizes something that is inherent in banking. If a creditor is going to keep a mortgage loan on its balance sheet, thereby retaining 100% of the risk of default, as a matter of basic logic, they are going to make sure that the borrower has a reasonable ability of repaying what is owed. That lender is going to make sure that that loan is properly underwritten and that that borrower is a credit-worthy risk. As the American Bankers Association stated in their letter endorsing this legislation, banks do not make and hold loans on their portfolios that cannot be repaid and stay in business very long. H.R. 2673 enjoys broad and deep support. In addition to the American Bankers Association, this legislation has earned the support of the Independent Community Bankers Association, the Mid-Size Bank Coalition of America, the National Association of Realtors, the Credit Union National Association, the National Association of Federal Credit Unions, the Conference of State Bank Supervisors, and the ABA's network of state banking associations, including the Kentucky Bankers Association. The need for this legislation has been made clear to me by community bankers throughout my district in central and eastern Kentucky. I regularly hear from these community bankers, and they are just exasperated. They've thrown their hands up and openly ponder getting out of the mortgage business altogether because they can't assume the risk and legal uncertainty of the Dodd-Frank law without this change. What these bankers in my district are simply asking for is to not have their best business judgment substituted for a one-size-fits-all rule handed down from Washington. They are asking to not be penalized for their business model based on relationship banking and knowing their customer. This bill also would create an incentive for mortgage lenders to move away from the originate-to-distribute model, which was, at least in some quarters, blamed for the financial crisis. Loans held in portfolio should be regulated differently than loans originated and then sold to a third party for a number of reasons. Again, here are the key distinctions from the originate-to-distribute model. First, lenders who hold loans in portfolio assume the risk of non-performance and default. Second, there is an important alignment of interests between the creditor's interest in performance and the borrower's interest in repaying the loan. According to Kentucky's top banking regulator, State Banking Commissioner Charles Weiss, state regulators have long supported a flexible approach to underwriting for institutions that retain mortgages in portfolio because interests are inherently aligned between consumers and lenders that retain 100% of the risk of default. Third, creditors with portfolio loans can work with the borrower to fix the problem if there is a risk of default. And finally, I want to reiterate that these loans held in portfolio would continue to be subject to the safety and soundness examinations by the lender's prudential examiner. These unique characteristics are why lenders who hold loans in portfolio should not be subjected to a Washington regulatory straitjacket and a one-size-fits-all qualified mortgage rule. Instead, where there is an alignment of interests and where the creditor entirely assumes the risk of default, the good faith efforts that lenders have taken to ensure the ability to repay should not be coldly dismissed and replaced by a top-down, one-size-fits-all rule from Washington. Again, this legislation enjoys broad support from a number of organizations. And before I conclude, there's one thing I want to touch on. I'm well aware that some may want to bifurcate this legislation and draw an arbitrary line to say that this common sense solution should only apply to institutions below some kind of arbitrary asset size that they themselves set here in Washington. But let me be clear. Having Washington pick winners and losers and arbitrarily dictating who deserves to take the hammer, even when a loan is responsibly held in portfolio, is poor public policy. In other words, a good loan is a good loan regardless of the size of the lender that makes it. So for those who seek to promote that approach, which customers are you going to try to take away that credit option from? Because at the end of the day, the customers are the ones who are getting hurt. The credit-worthy borrowers who are just trying to get financing so that they can purchase a home are the ones who are getting hurt. And with that, I yield back the balance of my time and urge my colleagues to support this common sense bill.
The time of the gentleman has expired. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, this carve-out applies to all banks of any size. The CFPB already provides for a small creditor exemption, so community banks who keep loans on their portfolio and work closely with their consumers can be competitive in niche markets where large banks cannot. This would allow banks of all sizes to issue any type of loan, even exploding arms, Alt-A loans, no income, and all other variants of subprime loans, because protections provided under the ability to repay rule only lasts for the first 3 years. Banks would have no incentive to keep them on their balance sheet. If a consumer got into trouble with one of these exotic products after 3 years, they'd be out of luck. This removes the common sense requirement that banks make a good faith effort to review paperwork and assure that the borrower can reasonably afford the loan. The CFPB has already created an exemption which preserves many borrower protections but still allows small institutions flexibility to determine how much debt a borrower with special circumstances can take. Mr. Speaker, Mr. Chairman and members, not yet, he says.
When the ranking member yields, don't believe everything you read.
This will be in the headlines tomorrow.
Did I get your vote?
Mr. Chairman and members, I can't believe that we're going where we're going. I have, of course, been very concerned about much of the legislation that we've had before us today because I see us going backwards. We have been through a subprime meltdown. We have been through a recession, almost a depression, based on the fact that we had all of these exotic loans and people signed on the dotted line oftentimes without knowing what the heck they were signing on to. Now, I know what has been said here today. First of all, the chairman said that the private banks had nothing to do with the recession that we found ourselves in, that they were not responsible for the meltdown that we had.
Would the gentlelady yield on that point?
I'll yield to the gentleman.
The chairman said community financial institutions, not private banks.
All right, so the chairman said community financial institutions. And I wish I knew what the chairman meant with that description, because in my working with him, He's always said that the dollar amount didn't count, that you couldn't identify the community banks by dealing with the dollar amount. And as we tried to work out what we do for community banks, he included in that banks that really were too big to fail when we were trying to deal with the problems of community banks. So I don't know really what he's talking about. But I have to tell you this, that if we don't recognize that no doc loans were part of this problem, if we don't recognize that even no interest loans, arms, exploding arms, if we don't recognize that these exotic products were part of the problems, and you may say that, you know, consumers should be smart enough to know exactly what they're signing on to, and the government has no responsibility to offer any protections, then something's wrong with you and your understanding of what happens in the real world. In the real world, a lot of smart people don't understand what they're signing on to. As a matter of fact, I've talked to members of Congress who have, you know, signed on to mortgages that they did not understand. In addition to that, when we talked earlier about some aspects of consumer protection, you constantly said that the government should play no role in trying to see to it that consumers are not misled in any shape, form, or fashion. And I can tell you, if you believe that, why do I hear so many people talking about financial literacy and what we do with first-time home buyers to help them understand what they're getting into? I believe that we do have a responsibility to see to it that the consumers of this country are not tricked, they're not led into mortgages that they don't understand, that they can't afford. I believe that we have a responsibility to do everything that we can to help people own homes and to stay in those homes. So when you talk about reverting back to where we were and allowing the kind of exotic products to go back on the market simply because they're kept in portfolio by community banks, however you define them, that I think that you don't recognize the tremendous trauma that the consumers have gone through in this country, where they have lost their homes, they've been foreclosed on, and you have communities that have been destroyed. Thank you, Mr. Chairman, for allowing me a little extra time. I yield back to Balance.
I believe the time of the gentlelady has expired. Chair now recognizes himself for 5 minutes. I think the ranking member said that she knew of members of Congress who had signed on to mortgages and did not understand what they were signing. I think I know members of Congress who have voted on health care bills who apparently didn't know what was in that bill at the time they voted on it. So I share her concern about members taking actions and not knowing the content for which they may sign on the dotted line or put their card into the voting device slot on the House floor. So I share that concern with our ranking member. And I was here along with her throughout the entire markup of the Dodd-Frank legislation. And one of the things I recall vividly from the debate, from particularly people on her side of the aisle, was we have to have skin in the game. And the reason that we had so many of these mortgages blow up is once they were originated, there was no skin in the game. The ultimate skin in the game is keeping the loan in portfolio. You got it. It's your skin, and it's in the game. That is the ultimate ability to repay protection. You are keeping the loan in portfolio. If we don't approve the gentleman from Kentucky's bill, we are yet again protecting potential homeowners from the risk of home ownership. We are protecting consumers in many respects from themselves. The ultimate protection is to ensure they never have the ability to own a home. So the spirit of the provision was to ensure there was skin in the game. If you have the loan on portfolio, you have skin in the game. Once you sell that loan and it is no longer in portfolio, it no longer receives the protection of H.R. 2673. It's only for as long as you have skin in the game. So QM can be an incredibly harmful rule. It is onerous. Again, it erodes the fundamental economic freedoms of hardworking American citizens. And but for the Fannie-Freddie escape clause that the CFPB put into the QM rule, today we would see a massive contraction. And we know it's coming down the pike already. Any survey of bankers will show what an incredible detrimental impact, when fully implemented, QM will have. And I will bring to the ranking member's attention yet again, because I've yet to hear one person on her side of the aisle push back or question the methodology or conclusion of the Federal Reserve that roughly 1/3 of black and Hispanic borrowers would not meet the requirements of a QM loan based on debt-to-income requirements. That was not the Dallas County Tea Party. That was the Federal Reserve that said it. I know of her great concern for the opportunities of minorities. Then let's protect it against an onerous QM rule. And so I think what the gentleman from Kentucky is doing is pure common sense. Again, at the margins, at least creating a few more home ownership opportunities, allowing a few more community banks and credit unions to actually stay in business and do what their communities and customers and members want them to do, and that is to help finance their version of the American dream, which includes home ownership for many. So again, I want to congratulate the gentleman from Kentucky for his hard work on this provision, and I want to encourage all members, I want all members to support this gentleman's bill. Chair yields back. Who seeks recognition? Gentleman from Missouri. For what purposes does the gentleman seek recognition?
Strike last.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'll be brief. I think there's 2 points that need to be made here, and I think the gentleman from Kentucky for offering his bill here. Number one, the way the QM is structured in committee last fall, we were discussing this, and the testimony was that only 54% of the borrowers would actually qualify for a QM loan. Now, after 4 months, I'm not sure where that number is. I'd be interested to see once what the actual number would be. But I know that it's significantly less than 100%. I know that the gentleman from New Mexico to my left over here has stated many times that mobile homes in his district make up over 50% of the home ownership, and yet they don't even qualify for a home loan. This is about access to credit. If the banks aren't allowed to make a loan and hold it in portfolio, it's going to be very difficult to provide the kind of credit that our citizens need, especially low and income folks, low and moderate income folks. This is choking them off for their ability to have the home of their dreams, as the chairman just indicated. And the problem is that there is a liability situation for the banks from the standpoint that an unqualified loan, which by inference means, or excuse me, a non-QM loan, which means by inference that it's not qualified, would put the bank at risk forever when that loan is on its books. And so it's really difficult to see how, when you talk to the bankers, they're sitting there scratching their heads. They don't know how to assess the risk that they have in their portfolio whenever they're keeping these non-portfolio loans. And I've talked to some guys, and they're concerned about it. A few of them are going to make them. Some of them just, quite frankly, aren't going to hold them in portfolio. So, and I asked the question when we were in committee of the regulators went in front of us, how are you going to analyze a non-qualified loan that a bank holds in its portfolio? How are you going to regulate that, the risk that the bank takes by keeping that non-qualified loan on its books? And I never got an answer. I have yet to get an answer from a regulator on that. And that's pretty significant when you look at the kind of risk that the bank is taking. One final point. Again, these are loans that the banks are holding on its own books. Again, they are not securitizing the kind of securities that were the problems in the meltdown. These are loans that the banks are going to keep on their books. They're probably, in order to make a non-qualified loan, you're going to make some customer that you've known your entire life. You've known their parents. You've probably known their brothers and sisters and grandpa and grandma. These are the kinds of loans that make communities what communities are. And I'll give you a quick example. I got a bank in my district that has a large hospital in it, and in order to attract new doctors to the community, they have to make a 100% loan. Now, technically, that doctor doesn't qualify for a loan because he's just got a med school. He's underwater with his loans. But your doctor can't buy a home unless the bank is willing to take a risk on him. And in doing that, it's a non-qualified loan. However, because that doctor's got the kind of income stream that can support the loan that he's taking out for a new house, they're willing to go 100%. Now, that's taking a risk. They sometimes get criticized by the examiners. But, again, you've got an income stream that can justify doing all this and, again, stop your community from growing and not allow that doctor to be a participant in your community and in the local hospital. That hurts your community in another way as well. So, again, a community bank, which holds these things, looks at a whole lot more of a range of things when you're analyzing a loan than just the nuts and bolts of whether the debt to asset ratio is right and all this other stuff. So, again, I thank the gentleman for his bill. I think it makes a lot of common sense. Again, these are loans that are only held in the local bank. They're not something that's sold. And I yield back the balance of my time, Mr. Chairman.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Tennessee seek recognition?
Move to strike last word.
Gentleman is recognized for 5 minutes.
Again, I'll be brief as well. I just wanted to reiterate the point that I support the common sense solution by Mr. Barr. As again, someone from a rural part of the country, we bank with a community bank. My family has for ever and ever and ever. And the bottom line is that lenders lenders at banks and credit unions know best if their customers can repay the loans they make. So we just need to get back to the common sense solutions. And I appreciate the gentleman from Kentucky, and I yield to him the balance of my time.
Well, I thank the gentleman's comments and observation. I also want to thank the chairman's comments, generous comments about this bill, and also the gentleman from Missouri and the points he made. And I think he made the point very well that this is about providing access to responsible mortgage credit, providing community lenders with the flexibility that they need to make sure that people all across this country have access to mortgage credit. But I do want to take the opportunity also to address the very legitimate concerns of the ranking member, and she makes a good point. We don't want to go back to the days of no-doc loans. We don't want to go back to risky loans. We don't want to go back to predatory loans. We don't want to go back to the kinds of subprime products that fueled the financial crisis. And that's precisely why I'm offering this legislative solution, because this wouldn't allow us to go back to that. If there's anything this bill is about, it is about addressing the concerns of the ranking member at the core of what she's concerned about. If a community financial institution originates a mortgage and retains that risk, that community financial institution, that lender is going to make darn sure that that is a properly underwritten loan, that there is a relationship built on trust and mutual accountability, that if that bank is going to retain that risk, assume that risk, and has that loan potentially as a losing proposition, they're going to make sure that that risk is a calculated risk, that it's well documented, well underwritten, and it's a responsible loan. And so, yes, it's about providing flexibility. Yes, it's about providing access to mortgage credit. But it's also about preventing some of the practices that actually caused the financial crisis. And I would conclude by just saying this. One of the community banks in my congressional district who has expressed considerable concern about the regulatory straitjacket that is the qualified mortgage rule that takes away the business judgment of the local community bank board is that the whole business of community banking has gone away with this QM rule. And what the president of the bank said to me, and what all of the board members of these local community banks say to me on a regular basis when I visit with them in central and eastern Kentucky, is that regrettably it used to be that being in community banking was about making a business judgment about the creditworthiness of the borrower. We made a business decision, and we lived with that business decision, whether it paid off in the end or whether it was a bad decision at the end of the process. But today, we no longer, that's not community banking in America anymore. Today, the government decides who is creditworthy and who is not. And that's not right. We should allow the bankers who live in the communities with their borrowers, who have personal, long-standing relationships with their borrowers. Sometimes their kids go to school together. Sometimes they go to church with these people. They know whether or not this is a borrower that is a creditworthy risk. They know whether this is a person of character and integrity who has a reputation for repaying these loans. Let's provide those community banks with the ability to continue to exercise that business judgment, and not just for the purposes of making sure that these people have access to mortgage credit, but also to make sure that we don't go back to the days of the originate to distribute model where there wasn't that relationship of mutual accountability. And so with that, I hope that my comments may have satisfied some of the concerns of the ranking member. I would urge her to join us in trying to prevent a future financial crisis and support this legislation for that reason. And with that, I yield back.
I yield back.
Gentleman yields back. Gentleman from Ohio, for what purpose seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate it. And, you know, my father was a community banker. My grandfather was a community banker, and they both did underwriting. When people came into the Citizens National Bank of Ripley to get a loan, they underwrote that loan. The thing we have with a qualified mortgage is to check the box underwriting. Either it meets the box or it doesn't. And to rehash the past, if we're going to rehash the past, the reason we got in a situation where we had some problems with loans is some financial institutions were originating loans that they kept no skin in the game on, and they securitized the entire thing through Fannie Mae and Freddie Mac, and they had no exposure. All they got was an origination fee. That's exactly the opposite of what we're talking about here when the gentleman from Kentucky creates this law that would require anybody that holds it in portfolio. That means they have 100% skin in the game. So of course they're going to do underwriting. And the point that Mr. Lukemire made is exactly the right point. Not everybody fits into exactly all the 5 boxes that you have to fit in to be a qualified mortgage. But if you fit in 4 of those 5 boxes and they know you and they understand, and let's say you're a new doctor and you don't have the down payment, but you have the income and you know it's the right loan to value and all the other criteria fit, then, and they believe, they know you're going to make money and save money, then why shouldn't they be allowed to make that loan, keep it in portfolio, and let that person live the American dream? The incentives align with this legislation to make sure the right things happen. So I think as the co-chair of the Financial Literacy Caucus, there are 2 ways to do consumer protection. You can deny people products, or you can inform consumers and make sure that big abuses aren't allowed and make sure the incentives are aligned so that people do the right things. We are choosing the second, which is to, you know, align the incentives and make sure that people can choose the right products for them. But I think that happens in this bill, and I think it will make sure that these banks who have to hold it in portfolio to get the exemption will have 100% incentive, because they have 100% upside and downside risk with these loans, to do real underwriting like my father did, like my grandfather did. And, you know, that system worked for a very long time. Nobody's talking about going back to no document loans. In fact, exactly the opposite, because they'll have 100% skin in the game, they will want a lot of documentation because they own 100% of the liability on these loans that would be allowed under this bill. So I think this is a good approach. It's an approach that makes sense, and it's an approach that allows our community financial institutions to serve their customers in the way that works for their institution. And they're not going to abuse it because they lose all the money if they make a bad loan. So it doesn't put any strain on the financial system. What put strain on the financial system is where they got all those loans securitized and pushed through the system, and nobody had any skin in the game. So I urge everyone to support this bill. I thank the gentleman from Kentucky for his sponsorship, and I yield back the balance of my time, Mr. Chairman.
Gentleman yields back, who seeks recognition. Are there any amendments? If not, without objection, the previous question is ordered. The question occurs on reporting the bill favorably to the House. Those in favor say aye. Aye. Those opposed say nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. And the bill is ordered. A recorded vote has been requested. Those in favor of a recorded vote will raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. The committee stands in recess subject to the call of the chair.